This crypto course will give you everything you need to get started trading cryptocurrency. All of these topics will be listed as timestamps down in the description below, alongside loads of other links, free resources, and other videos that I mentioned in this one. We're going to be looking at how macroeconomics affects crypto, why Bitcoin exists and how it spawned this entire industry, how altcoins play into this, then going ahead and analyzing crypto both from on-chain and technical standpoints, then how to actually trade. At the end of this video, we'll be looking at how to use a blockchain as well. If you don't know me yet, I'm James. I used to work on the London Stock Exchange, but I'm not your financial advisor and I can't give you any specific financial advice. So just keep that in mind when watching this video. Let's get started though with what exactly is crypto anyway. You may have seen sites like CoinGecko or CoinMarketCap and seen all these different cryptos and thought, what are these? How do they work? Are they the same or are they different? And why are they valued differently? Well, firstly, let's split up the difference between a crypto and a blockchain. A crypto is simply a digital representation of value. Now, that can be very different depending on the coin. You can have something like Bitcoin, which simply represents the Bitcoin network. Or you can have a token that represents a diamond or a bond. And so they're not the same and they're not equal, even though they're both crypto assets. Ultimately, a crypto lets us transfer or trade value from ourselves to someone else 24/7 peer-to-peer, meaning that there's no intermediary in between. We don't need a broker, we don't need an exchange, and we can do that on the blockchain 24/7. So ultimately, a crypto asset lets us transfer value peer-to-peer 24/7, 365. The blockchain is the actual thing that enables us to transfer those assets. So a blockchain is simply a ledger of accounts. When you create a blockchain wallet, what you're really doing is creating an account, just like opening a bank account. And if you had money in your bank account, the bank would keep a ledger of all of your transactions. Now, the difference with a blockchain is this is distributed amongst unconnected participants around the world. So there's thousands of people running the Bitcoin blockchain and they don't have any links to each other. And the blockchain keeps them honest in that they can't mess with our transactions. So when we submit a transaction, the blockchain sends it through and those nodes go and carry out that transaction for us. It keeps a record of history around the world. So it's basically like money in the cloud, but nobody really owns the cloud. And it allows for crypto assets to be sent between the accounts on that blockchain. So it's a decentralized way to send value peer-to-peer, and the blockchain network allows for that. No centralized authority like a bank or a money institution or a government. It's you versus me, and I'll send you money myself using the blockchain, and no one can get in the middle. Now let's look at the types of crypto that there are, because blockchains would always have a specific blockchain layer 1 coin that represents that blockchain. And when you want to use a blockchain, you have to pay a small fee to the blockchain participants for processing your transaction, and we call that gas. So if you want to use your Bitcoin and send it to someone else, you'll have to pay a small amount of Bitcoin to the network, and a small amount of gas is taken out of your transaction. Every blockchain will have a layer 1 coin that you use to pay for gas on that network. Tokens, though, are completely different. Tokens are built on top of blockchains and they represent something else, not the blockchain itself. So you can have protocol tokens or exchange tokens, and these represent something built on top of the blockchain. So there's a decentralized exchange or a decentralized lending protocol where I can lend money to you and you pay an interest to me. That's a protocol in itself, and that can have a token that represents the value of that protocol. There are also real world assets like stablecoins, which represent dollars in a bank. So we can easily send dollars around on the internet. And then there are many other types of tokens that represent something else. For example, if you use a lending protocol, you probably need a receipt for what you're lending out so that you know that you have it and you can call that loan back. Well, that receipt token would be its own separate thing, and it would more be like a utility token in that instance. Then you have non-fungible tokens, which we'll look at in a second. and of course, many scam tokens. Because anyone can create a token pretty much for free, there's going to be lots of scams and other types of tokens that don't really represent anything at all, other than basically the people that create them wanting to sell it to you to get rich. So everything exists on the internet and everything exists on blockchains. It can be represented by a token. There are really three main different types of token or coin. You have this one, the coins. These are the layer 1 gas coins that represent the blockchain network. Then you have tokens, which are fungible. This is a stable coin called USDT, and this represents dollars. Just like dollars are fungible, if I gave you $10, you could swap it around with another one and give it back to me, and it's fungible. I wouldn't care. It's exactly the same. It's $10. Same for dollar stable coins on blockchains. But of course, you need to represent unique things as well, which is why we have non-fungible tokens, simply unique things. So a token that represents one specific artwork has to be unique because you can't swap it with anyone else, and hence we get non-fungible tokens as well. They're the three main areas within crypto. So we know that coins and tokens can represent value in completely different ways and can have different attributes. And the way that we try to write down those attributes in a way that we can understand is called tokenomics. It's the economics of tokens or coins. And so these can be very different depending on the blockchain or the crypto asset itself. So let's have a look at this. Firstly, we value cryptos in dollars. So if you go to a site like CoinGecko, you'll see down here all of the cryptos, and they're usually listed by the most valuable first, which as of making this video is BTC. And you can see the price here. This price represents how many dollars it takes to buy 1 unit of the cryptocurrency. So as of right now, 1 unit of Bitcoin costs around about $46,000. Now you can buy a fraction of a Bitcoin, so you can buy 0.0001 of a Bitcoin, no problem. It's going to cost you a lot less money, but it's 1 unit of the crypto. How many dollars does it take to buy that? Now, every single crypto has a different supply, meaning that anyone can create these coins, and so they can create the supply themselves. So if we look at Bitcoin, we know that Bitcoin has a total supply. The protocol itself was written to have a total max supply of 21 million coins. That's all that will ever be created, and the protocol can't create any more of them. There is a circulating supply right now, which is the amount of coins that are in existence. It's around 19.6 million coins right now. So what we can very easily do is work out the total value of this crypto. We call that the market cap, or the market capitalization. So what you do is you take the price per 1 unit, around $46,000, and you multiply that by the circulating supply, which is around 19.6 million. And that gives you a total market value of $900 billion. So it's the most expensive asset in crypto as of making this video. We can also see there is a 24-hour trading volume. That's the dollar amount traded each day, which is this amount. And the fully diluted valuation is the valuation where we take the price per coin and we multiply it by the max potential supply, which is 21 million coins. So what we can know is that each coin has a different supply. There are a different amount of coins, and so they have a different price. But in order to accurately compare the value of each blockchain or coin or token, you have to look at the market cap. That's going to give you an overview of the actual total value. So we know that Bitcoin has a market cap of 900 billion and Ethereum has a market cap of 300 billion. And so Ethereum is around 1/3 the value of Bitcoin. But if you just looked at the price, you would see Ethereum is much cheaper. What we can deduce by this is that Ethereum has more coins than Bitcoin. So if you click into click into Ethereum, you can see there are way more coins. You're looking at around 120 million coins, right, instead of 21 million. So tokenomics can change, but to compare coins and tokens, we really need to look at the market cap. Why do people create these tokens? There are many different reasons. So Bitcoin was created by Satoshi and he created it as a peer-to-peer money and then left the network, and it kind of spawned from there. Other types of tokens can be created for other purposes. For example, ICOs, or initial coin offerings. That is when someone has an idea for a project and doesn't have any money. And so what they say is to investors, give us dollars so that we can spend those dollars to make our idea or our project real and, bring it into life. And we'll give you some tokens that we just created. This is basically the same as equity in the network that they're creating, or the protocol or the business that they're creating, right? And that's the same in equity as well. If you start a business, you can create equity within the business, and you can sell that equity for dollars or other fiat currency to fund your business. So what we can know is that Bitcoin may be very different to some other coins, because most other coins created the coin and then sold it for dollars to fund their operations initially. That's why people create these coins and these tokens, is to fund their idea. Not all of them, but that is a way that many of these tokens exist, is because you have entrepreneurs that need funding to start their network or their business, and they create a token as, investors can swap dollars for that token. And then the idea is that that token goes up in value over time as the network or the business grows. That's a very different thing to own than something like Bitcoin. Let's have a look at some tokenomics here that we can see. So we know that a human being can create a token, and that means that if they control that token, they can sell it to other people in any way that they want. Something like Solana is an example of basically an equity token. It was created by people that are in Silicon Valley, and so they're very comfortable with this kind of equity model. They created Solana, the token. They sold it to investors to get dollars to fund the operation to build up the blockchain. So what we can see here is that the token was created, and a huge amount, around 25% of the supply, was given out to investors in what's known as a seed sale. So the token is given at a very, very, very low valuation for people to put money in initially to fund the initial idea. So 25% is owned by a very small cohort of investors. You then have another founding sale, which is again just a way to raise money. So you give people these tokens that you created that represent some amount of the network, and you sold that to investors. The foundation also owns a ton of these tokens. The foundation is basically the things that run the network and make sure that it's up and running all of the time. Then you have the team that own 20%, and then tiny, tiny amounts that represent the public sale, which is, open market investors that can just buy it in the open market. This is kind of representing what would otherwise be known as a company. So it's very similar to how, startup companies operate, where you get a huge amount of the supply owned by a small amount of early investors. That's not amazing as a representation of money itself, but it could represent the equity of a network. But it's, again, very different. So you can see how these coins and tokens represent value in different ways. There is also a supply schedule over time. Most of these coins will start with a smaller amount of supply and then increase the supply over time to a later amount of some amount. The reason is, as you can see, the supply increases to give some network participant more coins over time. So for example, the foundation could have a lot of tokens that vest over 10 years. And so they get a little bit each year over that time. Maybe some other investors get tokens given to them over time, or you can pay out staking rewards for this type of blockchain, which is an incentive to network participants to actually run the blockchain. So what we're saying here is that we're creating value in some way and giving it out to people to do something. And then we hope to create more value over time to make the thing more valuable. This is Cardano ADA, which is a very similar type of blockchain, a smart contract chain. You can see that the initial coin offering was around 60%, staking rewards over time around 30%, and then the team got around 11%. So this is definitely more distributed than Solana. The ICO is an initial coin offering. That was initial investors that could get in. but it's certainly, slightly more distributed than something like this, where you're getting a huge amount owned by basically insiders. So a little bit different there. And you can see the supply schedule is pretty standard, right? You have the token sale and the team, and then you have staking rewards over time that try to incentivize people to run network nodes to run the network. Then you have BTC, which was created by Satoshi, no pre-sale, no ICO. He simply created the protocol and he started mining the network initially. Now, Satoshi's coins have never moved, and so they're essentially lost coins at this point. So no control over them or the network. This is very different in terms of its tokenomics, because what you're seeing is over time, the supply started at 0, and the proof of work network has created all of these coins up until 21 million, where it will just simply stop producing new coins. These are the block rewards. As new coins are created over time, that of course goes to 0. As block rewards go to 0, the emission of new coins is 0. Hopefully this shows that Bitcoin is very, very different to most other stuff, where most other chains created these coins or these tokens, sold them to investors to get some money to fund their blockchain projects, and it's owned by different types of people. Bitcoin is really different in that respect, where it was designed and created to be money and nothing else, and it has this extremely fair schedule over time. So how do any of these coins or tokens represent value or capture value in some way? For Bitcoin, it literally does nothing other than represent the Bitcoin network. Because Bitcoin is decentralized as a network, it is strong and reliable, that network has some value because people may want to store some value in that network. And so Bitcoin simply represents the blockchain's value. For smart contract chains like Ethereum, things can be very different. Ethereum is more of a computing platform, and it lets people create smart contracts where they can do things together. So they can trade or they can lend and borrow, and they pay fees for that. And so Ethereum is a decentralized network as well, but it also earns very good fees, and it pays those fees back to users if they stake their coins. We'll get to that later. But because Ethereum pays fees back to users, it also has some value because it pays a yield to them. Bitcoin pays no yield, but Ethereum does. And so Ethereum may have value in different ways. A stable coin that is essentially representing $1 only represents $1. If you invest in this, you just are holding dollars, and therefore it's not an investment and there's no value to be captured. You can see that right here, that Tether is valued at $1 and always will be valued at $1. So that simply represents something else. Then you have protocols like Uniswap, which is a decentralized exchange. An exchange charges fees to its users who trade tokens. And so if an exchange charges fees, it's basically a business at that point, and you can value that token based on how many fees it makes and if it passes some of the profits back to you as an investor. So blockchain assets represent different things, and they have different values depending on what exactly they do. You may be wondering where I get all of this information. All of the resources that I show you in this video and everything that I use will be listed down in the resources section in the video description. I recommend getting an account on X, formerly Twitter. Lots of news and research on there, and it's a great resource. There are also tax and portfolio trackers that you're going to need if you're trading in crypto or investing. Now, your exchange may give you this for free, so definitely don't pay for anything if your exchange is going to give you that for free. Look on your exchange though. Now, for research and analytics, these are amazing. Look into Bitcoin, DeFi Llama, June Analytics. They show you everything that's happening on the blockchain in real time. It's a fantastic resource, and we can do this because of blockchain technology. If you want pricing data and charts, definitely use TradingView. It's industry standard. It's free to have an account and look at pricing data, so why not have it? Now at this point, I want to plug the crypto course as well. This is the professional version of what we're doing here. You can see that there's a Discord group where you can come and ask me questions. I update the course for free of charge forever. I'll leave it linked below. I get much more in depth into, really what's going on with the crypto types. You can also see a lot of trading articles as well. We have an entire trading section a little bit more professional than what we'll do in this video. You can see all of these different videos here. If you want to request a video because you don't know something or you want to ask me a question, just come and ask me in the private Discord group. So I'll link the crypto course below as well. And I update it with all of my research. I just updated it as of making this video, as you can see here with my latest research and what I'm doing with my portfolio and everything like that. So lots of resources to use, and just check everything down below. Now we move on to a crash course in how the macroeconomy can affect crypto prices. The macroeconomy, which is really interest rates, central bank policy, all of that over the short term can manipulate asset prices. So central banks control money, the fiat currencies that we use to trade. And they control the interest rates on the debt that we take out, and they control the supply of currency that we use. And they do that to try and push and pull us into this kind of smooth and predictable way of moving in the economy. So every central bank tries to grow its economy a certain amount. And of course, economic growth is not the same around the world. Some countries have a young population that are growing and producing more value. Other countries have an elderly population or an older population that are just past their best years and are not producing as much as they did before. In any case, central banks know that they can't control that. You can't control demographics. But what you can try and do is slow the pace around and not make it, too crazy, because financial markets don't like to be upset. If they know where the destination is, they're fine with that. And if they get there slowly, then they can plan for it. But if things are unpredictable, markets are mayhem. And so central banks really just try to slow the pace or the extent of any, financial moves that may rock the pricing mechanisms that we use to trade. And so what this has come into in modern finance is really this cycle of macroeconomics. And so everything is tied into one, of course, because everything that happens in the world influences the price of the assets that we trade. But the main cycles that we can look at really that influence what the price of Bitcoin is on a given day, or what interest rates are, the cycles that influence that are the business cycle. So that is, the business cycle has periods of expansion where businesses are taking on more debt or, raising more cash and selling equity to expand, bring on employees, which reduces unemployment. A lot of employment in the economy means people are earning money, and so the economy can grow. And of course, the other side of that is the times when that business cycle kind of deflates a little bit. Maybe businesses are making people unemployed. That leads people to save a little bit more and pull back. And so you get kind of a dip within the economy. So the business cycle for businesses, are they hiring or are they firing? Are they growing? Are they kind of paring back, right? So that's a business cycle that will, of course, affect the price of assets, Bitcoin, housing, everything else. There is also a debt and refinancing cycle because most businesses use debt to fund growth. Governments use debt to fund growth. And there is around a 3 to 5 year financing cycle. So the average maturity of debt is around 3 to 5 years. And so every 3 to 5 years, what do? Do you pay off the debt? Do you refinance the debt and, try and get more growth? Right? So that is going to influence things, right? The demand and supply for debt. That is a market within itself, and the interest rate that is charged on that debt is going to massively affect the economy and therefore prices of everything we trade. There is also an election cycle, right? Because most governments are going to try to get elected. And how do you get elected? People have got to feel good about their situation, which means their assets are going up in value. They have employment opportunities. And so you're going to try and put political pressure on the central bank to try and raise or lower interest rates for your political gain. It's definitely an influence on things. And then amongst all of this, we have the Bitcoin cycle, which is the cycle Bitcoin has every 4 years to halve the amount of new Bitcoin coming into the supply, We know that Bitcoin has this inflation schedule like this, where it eventually top out. We're somewhere here right now. Every block of Bitcoin that is produced, you get new Bitcoin that is made and paid out to miners as an incentive to carry out transactions. Every 4 years, the amount of new Bitcoin given to them is cut in half, and therefore the supply changes. So you have the Bitcoin cycle as well. That happens every 4 years. This happens every 4 years. This happens every 4 years. This just happens to coincide with debt, and elections happens to be around 4 or 5 years. These are short-term cycles. So that is very different to secular trends. So we're going to look at this on charts right now for crypto assets, because secular trends are entirely different to cyclical patterns within prices. Election cycles, debt refinancing cycles, the central bank lowering or raising interest rates on the debt that we pay changes prices within the economy. These happen in cycles like this. However, what central banks cannot influence and governments cannot influence, really, long-term, are these long-term secular trends. What is a secular trend? Technology is a secular trend. Computing is a secular trend. Internet adoption is a secular trend. Bitcoin and crypto adoption is a secular trend. AI, technology, again, is a secular trend, right? So what we can say is prices move in cycles based on what central banks and the business cycle are doing. But over the longer term, secular trends will get moved by this, but eventually just go in the direction that they are destined to go in, which is growing. So you have something, an invention of something that starts small, solar panels, self-driving cars, AI, the internet, and eventually that thing is just desirable by enough people that the thing just grows over time. But it doesn't grow in a straight line, of course. It has cycles along with adoption. If there is a recession, that means people are doing less stuff and they're demanding less stuff. And so the price goes down. But when there is another expansion in the economy, then that will go up. The long-term secular trend, though, is what investors look at. So if you have a time horizon of 5, 10, 15 years, which most people investing for their retirement or anything will have, then what they're really looking at is secular trends. You don't want to be trading cycles over and over again and trying to buy, sell, buy, sell. You're just looking at what things are growing in a secular trend over time. And I'll be buying here and buying here, but that doesn't matter because over time, the trend is up. So that's what we want to look at. There's a big difference between cycles and secular trends. Secular trends can happen to the upside, but they can also happen to the downside. So you can get cycles within things that are actually getting worse or less desirable over time, or just becoming less valuable. So we can obviously get caught out on both of these. For example, we can get caught out in secular trends to the upside by buying here. The price falls down, we get upset, we sell here, and we've just traded the cycle the wrong way round, and we aren't aware that what we're doing is actually in a secular trend to the upside. So if we just kept it and dollar cost averaged, we would get higher at some point in the future, right? Secular trends happen to the downside as well, in that you can maybe get into something here, it looks great and you think you've made money, but then the next trend down is lower, right? You can see this trend. So secular trends and price cycles happen, and that's very important to be aware of. But what's way more important is the secular trend of that thing. Because if you're confident in the secular trend, you can invest in it. You can't invest in cycles. This is an example of a secular trend. This is the purchasing power of the dollar. Now, this is an example. Most other fiat currencies look exactly like this as well. Whereas the purchasing power over time in relation to a bunch of desirable assets has just gone down. This means that if you held dollars in 1971 they're worth around 20% of what they were then. So if you hold the same dollar, you can only buy 20% of the things that you could buy in the 1970s. There is a reduction in the purchasing power of the dollar. That just happens to coincide with the circulation of the dollar, which has risen. So as more dollars have been printed by the central bank or the government by issuing debt, so it's putting fresh new dollars into circulation, that has been printed at a faster rate than humans have printed resources through their efforts and their value and their labor, or the fruits of those labors like goods and services. More dollars are being printed over time and put into circulation than value has been created. This creates a debasement of the purchasing power of those dollars in relation to the goods and services produced. So there's more circulation. That's a secular trend because we were looking over the long term. A secular trend of more currency in circulation and less purchasing power. There are cycles within this, but the secular trend is very clear. All investors know when they start investing, when they realize this, is I need to get out of that fiat currency if I have savings that I want to protect from this currency debasement over the long term. It's not about making money in the markets. It's not about trading. It's about knowing the secular trend is that fiat currency has been losing its value, and so we need to escape that and put our value in things that do not debase at the speed and rate of this. This is a secular trend of the purchasing power of fiat currency going down in relation to desirable assets. This is another secular trend, which is the Federal Reserve in America and the size of their balance sheet. We're not going to get into how this works. We can just look at the secular trend in that it seems like the Federal Reserve, their balance sheet is getting larger over time. How does the Federal Reserve buy these assets? It prints money to buy them. So the secular trend is that the central bank is printing money, increasing the supply of money to buy stuff. What that does is debase the purchasing power of everyone else's money because there's more currency in circulation over time. They are buying assets, printing money to do so. This is a secular trend with cycles in between. This is also a secular trend. You can very clearly see that there are cycles here, but since the 1950s, with cycles in between, this is a secular trend to the upside. This would have been a great investment. If we started down here, we've made tons of money. Unfortunately, what this is inflation. This is the price of desirable things in the economy over time. The price of desirable assets and things that we need to buy to stay alive, like food and shelter, are going up exponentially. This is not good for us because the things that we want to stay alive are becoming more and more expensive. Now, this alone doesn't matter too much because as long as your wages are going up at the same rate, then things aren't getting more expensive for you. So you have to look at your wages and how they're increasing in relation to the inflation of goods and services. And of course, wages may go up. Overall, they may not go up. And so inflation actually makes you poorer. But what we can get from this is that the price of stuff that we want never goes down, ever. When it goes down, what happens is that the central banks step in and force the price of everything up again. It never goes down. It just goes up at a slower or faster rate. So these things are linked, right? You can see that the purchasing power of money goes down over time as the currency in circulation increases. that is also tied to the central bank, which prints money to buy assets for itself to try and control things in the economy. And inflation goes up seemingly in line with the fact that we have so much money creation for some reason that is pushing prices up. So these are secular trends that investors inherently know. My dollars or fiat currency buys less stuff over time. I don't like that. So I need to sell that for assets that go up at the same rate as the other things that are going up that I want to buy. And in 20 years when I retire, I will have saved the purchasing power of my money in those assets. So those are secular trends, but we can also look at cycles as well within parts of the economy. So this is from GMI here. We have inflation, which, as you can see, moves in cycles up and below around about 2%. Central banks around the world, most of them have a target of 2% inflation. Don't ask me why they have that. Nobody knows the reason. They just picked 2% as some number that if it happens at 2% a year, no one will really notice that the things they're buying are going up in value. And so what they try to do with their central bank policy is to keep this inflation rate around about 2%. What is the inflation rate? CPI, which is the Consumer Price Index. It's an index of the things that consumers can buy in the economy: meat, vegetables, Netflix subscriptions, everything like that. Now, CPI is just one metric of inflation, and really they change it all the time. So CPI can be changed by the indexer, the government basically. They can take one thing out and put another thing in. And so CPI doesn't really mean much, especially if you change it over time. Also, when you're looking at consumer price inflation, a lot of things that we buy over time actually get cheaper because of technology. We produce more of them, we have economies of scale, or we digitize them to make them cheaper. In any case, that CPI is still going up. And is it the things that are getting more expensive, or is there just simply more currency chasing the same amount of stuff, hence pushing the price up? In any case, inflation moves in these cycles. So sometimes it goes above 2%, sometimes it goes below, like this, right? But we know that even though these cycles are taking place and they will be changing the price of assets and the supply and demand and everything like that, we know that the actual secular trend is just positive. All of this mostly is positive in terms of there is more inflation, right? In CPI. So CPI moves in cycles, and inflation will inhibit a response from the central bank. If inflation gets too high, central banks will try and reduce activity within the economy, maybe an economic slowdown. If inflation gets too low, they'll try and stimulate the economy by lowering interest rates to get it around this 2%. That's what central banks want to do. That's their official remit, is to keep inflation around 2% by stimulating the economy or drawing it back. You can see here that this is the official interest rate for US Treasuries, which are the benchmark for what debt trades at. So you have US Treasuries, which will trade at a certain percentage, let's say 3%. Everything else is priced off that. If you're a company, you're a lot more risky than the American government. And so maybe you have to pay 10%, which would be, this plus 7. And that would make 10% as your spread as a company. So all interest rates are really set off of this. Now, what we can see here is cycles within a secular trend. You can see the cycles here, they move. These are the cycles, but the secular trend is that interest rates have been coming down over time. So things move in cycles, but we can't get caught out by those because we need to look at the longer term secular trends. But we can also maybe take advantage of those shorter term cycles as well if we're confident in the secular trend of something, right? If trends are topping out and you know that there's a secular trend to the downside, maybe you can trade to actually make some profits around these changes in the cyclical patterns alongside the secular trend that you think that's happening. This is global liquidity. This is a measure of how much money is flowing around central bank systems, because They try to manipulate prices and economic activity by sloshing around money. They pour it in, they take it out. They want everything to be moving at 2%. We can see that this is cyclical as well. So you get drawdowns and you get points where liquidity is higher. This seems to move in cycles. So liquidity moves in cycles, which is an attempt from central banks to manipulate prices in cycles. However, cyclical trends rely on fundamentals like demographics, how many people are being born, how much value is being created, is something in demand and going to be in demand over a 20-year period more and more and more. We know the difference. So what do we want to do? We want to watch out for cyclical trends to invest in, right? Because we've got this money that we're earning and we need to save some of it. That's why you're here, right? You're looking to invest or trade crypto, and you're looking to save, purchasing power of your money over time. You're looking to make dollar price gains or fiat currency price gains in assets that go up over time. So we know what we need to know is something in a secular trend? And if it is, how can we take advantage of price cycles to get the absolute best prices, right? Investors, if you've got a 20-year time horizon, you just want to invest in secular trends. Invest for a long time, wait an even longer time. The trend will have carried the price and the value up. So what you can see here is this is the Bitcoin price. And we can very clearly see that it is, one, really volatile, but it also has traded in a couple of different cycles. So you can see an expansion cycle here. You can see a destruction cycle. You can see an expansion cycle, destruction, and it looks like we're going in expansion. So it seems like the price moves alongside cycles within the macroeconomy, like this, right? So what we have here is liquidity moving up and down and Bitcoin moving up and down. So what we're going to do is press indicators. Like I said, TradingView that I'm using now is completely free. Definitely recommend an account. They'll be linked below in the description. You just need an email address, sign up, and you can use this. We're going to look at global net liquidity, which is a measure of the liquidity from central banks. So are they pouring money in to stimulate, or are they taking money out to try and calm down growth? There is seemingly a correlation here. We have an expansion in monetary policy. We have an expansion in liquidity. That just happens to coincide with Bitcoin going up in price. As money is drawn out, you can see that just so happens to coincide with the Bitcoin bear market and the price going down. We have another massive expansion in liquidity here. That just happens to coincide with a big price expansion in liquidity in Bitcoin. We have liquidity coming down here, and we can see the Bitcoin price going into a bear market where the price goes down. These things have a very high correlation. So what we can understand from this is that it seems like the amount of money in circulation from central banks affects asset prices in cycles. When there is an expansion of liquidity in central banks, what they're doing is increasing the supply of money. And conversely, things that have a fixed supply, or a supply that can't change as quick as that, have to go up in value, right? So if you have the same amount of stuff like Bitcoin or gold or a stock, and you have more dollars chasing that, then the price has to move, right? The price moves in cycles along with this. So this is very, very clear. So we can see that price moves along in cycles for BTC. So the other thing we can see is a secular trend. Now, this doesn't really seem like a secular trend. I mean, it kind of does a little bit, but you can't really see it. So what we're going to do is go down to the settings here. And rather than looking at the actual price, we're going to change the chart to a logarithmic chart. Now, what this does is it changes the price scale and compacts or compresses the price scale as the price of the asset moves up. And this creates a totally different type of chart that we can see. What we're doing here is looking at Bitcoin since inception and its price. And it's very, very clear that we can see a secular trend. If you want to know exactly how to use TradingView, by the way, I have a completely separate tutorial video. It goes through absolutely everything using the charts, using the drawing tools. So I'll leave that link below. But what we can see very clearly now is that we have a secular trend in the price of Bitcoin. Now, Bitcoin is a monetary network, and so more people are adopting it over time. We'll look at that data. But even though the price is moving in cycles, which we can very clearly see, expansion, contraction, you can see all of that happening. What we can tell, and that was drawn quite badly, but what you can tell with these cycles is there is a secular growth in the price of this asset over time. Secular growth with cycles in between of boom and bust. But the trend for 15 years is that within these cycles, Bitcoin adoption is growing and therefore price. Let's have a look at another crypto asset just to see if we can get a trend here. So this is the price chart of Ethereum. We can see some cycles here, right? So boom and bust for sure. If we put the logarithmic chart on, we can see that again. So it tends to give us another secular trend, right? So we can draw that on the chart from here and upwards. We see again that there is a secular trend that seems to be growing the price of this asset. So cycles of boom and bust, but very clearly a trend to the upside. So in each bust, the price is higher. In each boom, the price is higher. What's happening here? You have an asset that starts at zero or close to zero, and you have adoption, a secular trend in adoption over time. More people are using this thing. It goes from tiny to small medium to medium to medium large to large. At some point, the pace of growth will slow down. And that's fine. That happens to every asset. But we can't get distracted by price cycles because what we're really investing in is the secular trend. We can, of course, take advantage of price cycles as well. As price cycles draw down, these are fantastic opportunities to invest in what we know is growing in a secular fashion to the upside. So we can buy every price and wait, or we can be a bit more tactical and try and buy more when prices draw down within the longer term secular trend. So let's recap how macro changes crypto prices. Now, that's a tiny amount of macro there. It's obviously a huge topic that could be a course in itself. But how macro relates to crypto. Short-term price cycles happen within longer-term trends. Traders try to time cycles. So you're looking to time this, right? Buy these lows, wait for a pump, sell here. That's more active, it's more risky because we don't know where the prices are going. But investors just look at the trend and say, I'm going to invest for 10 years, then wait another 10 years for that growth to come. Cycles give all of us an opportunity to invest or buy at lower prices. Investors must be active buying assets when they are at the price cycle low. Otherwise, you're simply getting worse prices for the thing you want to buy. The whole idea here is to buy the most stuff at the cheapest price. You can do that by being extremely early and taking way more risk that the thing you're buying simply is a bad idea. Or you can wait till something is bigger, but you have to invest when prices are relatively lower than the expansion cycles. Otherwise, you're just simply paying more for the same thing. So we can use macro cycles to our advantage to know that we have assets that have secular growth. And during these price cycles, we don't get scared. We don't get taken out of what we're doing. We invest at those lows. They're going to give us the best returns. Understand that cycles draw prices down, especially in crypto. This is a new asset class. It's volatile. It's young. It's not valued highly, and so it's going to be very, very volatile to the upside and to the downside. So we need to make sure that we're active when the downside price cycle hits and investing in things that actually have long-term growth. The best time to invest is at the low of a price cycle. Invest in secular bull assets during cyclical bear markets. That doesn't mean that everything we buy that draws down is going to recover. That's also the risk with investing, is that many of these things will have one cycle go down and then keep going down. That's obviously the risk. But we know that the things that do grow over time give us plenty of opportunity to make money because we're still early on in crypto. Let's move on to Bitcoin, why it spawned the crypto industry, what exactly it does, and why more people are coming to the network over time. Very clear to see that Bitcoin over time is growing. It has price cycles, but the secular trend is to the upside. Why is this? Bitcoin is often called money, or the strongest form of money, right? Hard money. And the reason is because it has a cap in the supply. So it's an asset that runs on a decentralized network. So you can essentially own this asset. No one else can fiddle with the asset. They can't change it in any way. It's 21 million coins and that's it. It's non-government money. It's an asset that you can hold digitally. So it has some desirable properties, right? It must have, because a lot of people are coming into this. People say that Bitcoin is money, but is it actually money? Money itself isn't actually real. Money doesn't exist. There is no such thing as money. There are assets and liabilities. Each one of us has a balance sheet. We have this individually as people. So we either own assets or we have liabilities that we have to pay for. Companies have assets and liabilities, and countries and governments have assets and liabilities. Many central banks around the world own gold. Many of them have huge liabilities to pay out in social security and other things. Money itself doesn't exist. Cash, fiat currency, that's not money. That is just a way that we account for the balance of trade between people, where they're buying or selling assets and paying out their liabilities. The way that we do that is simply by having a unit of account that we all agree on in some way, right? So I've got $1, you've got £10. That's just a number, completely irrelevant number that doesn't mean anything apart from the system by which we exchange these for goods and services, and we accept that that number that you're saying, which is 10, is enough of a number to pay for the thing that I'm selling you. So it can be a physical sheet, it can be a number on your phone when you're just paying for something. So money itself doesn't exist. There is only a balance of trade between individuals, and the way that we carry out that trade is through exchanging numbers. We used to exchange physical goods like cows and chickens. That wasn't a good way to do things. Then we eventually came to shells and salt and everything else. Then we eventually came to, let's just exchange numbers and use a sheet of paper to do that. Then we realized we can just send it on our phone, so we send the number on a phone. But all of that eventually became centralized, right? So you needed banks and you needed governments to make sure that people weren't, taking things into their hands and scamming everyone else. Bitcoin. We use currency as a number, a made-up number to account for the balance of trade during financial transactions. Fiat currency is unreliable because there is a long history of governments printing more of it. We've just seen that the purchasing power of dollars going down over time. The reason governments print money is to pay for national security, military, health, education, and they can print and print and print because they're the only ones that own the money printer. We're not allowed to own our own money printers. That's illegal, and we'll go to jail. Only the government is allowed this monopoly on money. Therefore, they can print as much as they want, unless we get tired and throw them out of power, right? The problem is it distorts the way we account for value within the economy when you are printing money and pushing it out into the economy. People who earn value need to save their output in an asset because the currency is unreliable. Every currency ever invented, every fiat currency has been debased by the people in charge of it. Because they don't want to lose power, they print to take power from other people through their military, or they bribe voters by printing money and giving them free healthcare and free education in order for their votes to stay in power. But what that does is debase the purchasing power of everyone else's currency. Therefore, we all know that if we want to save the value of our value over time, the things that we've outputted into the economy and received income for, we need to take it out of that currency, which is being controlled by someone else who we don't trust, and we need to put it into assets, stocks, stock indexes, gold, housing, anything else, art, diamonds, right? Because we know that they control the money and they fiddle with the supply. Assets are priced based on supply and demand and desirability of them. Bitcoin doesn't do anything other than give us a promise that it will always be there and it will only be 21 million coins. And if we compare that to the fiat currency, there may be some desirable properties of this type of asset. Maybe Bitcoin and maybe other networks can do this as well if they're sufficiently decentralized and they won't be fiddled with. So what is money? It's a medium of exchange. That is something that we can exchange to account for the balance of trade between you and me. I earn money, I go to your shop, you sell me a coffee, you tell me it's 3, I give you 3, right? Doesn't matter what we called it, dollars or pounds, doesn't matter. It's something that we all say, this is 3 of that, I agree, right? It's a unit of account, right? So we have to account for the balance of trade, and it's a store of value. Well, fiat currency isn't a store of value. We've definitely seen that. And so that's why we use all of these other types of money. For example, housing or gold or commodities, right? So what is money? Well, money can be pretty much anything. It's something that we associate with value that we can exchange freely for the balance of trade of goods and services. Ultimately, what money is a database. It is a way to put inputs in and create outputs, right? It's a unit of account. It has to be stored somewhere. So fiat currency does this by having a central bank and then consumer banks who keep a value of the balance of trade of all these numbers flowing around. And that is their database. A central bank is a centralized database controlled by the government. And they can print the money, they can control it, they can stop you having access to that database, right? That's not great. What is cash? Cash is also a database, but it's different than the central banks because it's physical. So as long as someone else accepts that cash from you, that is also a balance of trade transaction, and it has numbers on. So that's the way we account for that. The way that fiat currency's database is controlled is through military operations and power, right? What you're saying is no one else is allowed to control this database. And if you do, we'll put you in jail. You can't have your own money printer. Also, if someone else tries to take our database from us, we'll use our power. Centralized databases that are controlled through power and physical force. Bitcoin, it is a database that is decentralized around the world. No single party has ownership of it. No single party can control it. It is a decentralized database that no one can have specific control of. And so we use the proof of work network in Bitcoin with energy. People that want to earn Bitcoin by mining this network need to have energy. There is a cost associated with having this network, and there is a cost associated with trying to destroy the network. If you want to destroy the network, you can't just use force. You have to get energy. You have to get 51% of the network to control it. That's almost impossible because of how decentralized it is, right? Anyone can mine the network, decentralizes power over time. Is it absolutely perfect? It's certainly the most perfect thing that we've discovered so far, and it's certainly more perfect than centralized databases controlled through force. So Bitcoin is very simply a cloud database. That's all it is. It's a database that we can use to transact in Bitcoin. It's fixed in supply, it's decentralized, it's not controlled, and therefore it might have some desirable qualities if you're looking to preserve the purchasing power of your value over time. Like I said, there is no such thing as money. There are assets and liabilities, and there is the balance of trade. What we use for that balance of trade really has changed throughout time. Salt, clamshells, right? Coins, and some people are using BTC. There is no centralized issuer. It is fixed in supply. It is self-custodial if you want it to be. You can have, it's a bearer instrument. You can have ownership of it, actual ownership, right? It's not in a bank. It's not controlled by a centralized party. Bitcoin is absolutely impossible to replicate as a thing. It just is the invention. You cannot create a new Bitcoin. No one would want it. Bitcoin is the culmination of the consensus of the people that use it, that this is the best thing for them. It's pure capitalism. Bitcoin is money, just like gold is money or housing is money or other assets are money because they have value. It's not really spending money, right? We're not going to buy coffee with it or buy a bar of chocolate with it. It's not really what it's used for, right? Mainly because there are legal tender laws, which means you can't really spend it. Your government may tax you when you dispose of it. So it's not really like currency, but it is a money. Bitcoin is known as monies, the group of assets known as monies. It's non-government. It can be saved or spent, probably not for coffee though. You spend it when you sell it later for the currency of the country that you're in, so you pay your taxes and you pay the legal tender that people need to accept. Bitcoin is not legal tender, therefore it's not currency. Some countries made it legal tender, good for them, but in most of the world, it's more of an asset. Because it's digital, it can be very versatile. You can save it and spend it, which means you can save $1 billion of it in an investment fund, but you can receive $50 of it for work that you did and spend it on something. So because it's digital, it's very, very versatile. But really what it is a decentralized database for value over time. And so it's an account for the world, right? It's a savings account for the world who want to use it. I want to quickly go back to the macro, which we were looking at earlier. Remember that we have these cycles, the halving cycle every 4 years for Bitcoin, business cycles, election cycles, debt refinancing cycles. So we know that secular trends move up and cycles drive prices over time. We also know that the supply of Bitcoin over time is increasing, but it will eventually get to 21 million coins and then stop. Very different to other types of currency. This is the supply of gold versus BTC. So what we have here is the inflation rate of gold. Gold is seen as a scarce asset, desirable asset, but price hasn't gone anywhere for 15 years or so. The supply of gold is infinite. It's not a scarce commodity. It's a commodity and not a scarcity. Gold exists on the planet and you just find 2% more of it each year. Gold exists on other planets. Elon's going to Mars. How much gold is he going to bring back? Is the price going to go down because the supply just shoots up? Bitcoin is protected by its network and you cannot control it. As it gets stronger, you simply need more and more and more energy in order to attack the network. Well, it hasn't been taken over in 15 years and the network hash rate is going up and up and up. There is more and more and more energy protecting Bitcoin's network over time. Bitcoin's supply is going to reach 21 million and no more can be created ever. You've got the supply of gold going up forever. You've got the supply of everything going up forever. Commodities, there's an unlimited amount of them. Bitcoin is truly scarce. After the halving in 2024, the inflation rate of Bitcoin will drop from around 1.8, 1.9% down to 0.9%. So each year, the inflation rate is 0.9% more Bitcoin in circulation. 4 years after that, it will get halved down to 0.45%. and then halved again and halved again until eventually there are no more coins. This asset potentially is desirable to invest in because it is genuinely scarce. And everything else that we've tried, currency-wise, has not been scarce. So maybe there are some desirable properties here. How about if we compare it to real estate in terms of an investment, a savings method over time? Real estate has a lot of downsides. You have management costs, insurance costs, stamp duty, or whatever the tax is called in your region, fees. The thing gets worse over time. It degrades. You have to pay a lot of money to upgrade it. It's very, very high ticket to invest in. If you want to invest in property, buy your own property, for sure, you need to live somewhere. But if you've got money left over, is another investment property the best thing for you? Do you have that much money to pay for the deposit and the mortgage each month? Do you want to save up for another house, which is very, very high ticket? It's massively illiquid as a market. Can't sell 1/8 of a house. Can do that with Bitcoin. It's extremely high cost and high fee when trading in and out, right? Depending where you are in the world, 3, 4, 5, 6, 7%, and then stamp duty as well, if you've got profits there. It's not fixed in supply because you can just create more of it, right? Buildings get higher over time, things get refreshed. The benefit of real estate is that you can use leverage. So yes, you can buy an entire house if you put $20,000 down, if you've got that. So you can use leverage, which means potentially higher gains if you're comfortable with using that leverage. Because a mortgage is leverage. You're taking debt to buy an asset. Inflation adjusted income, because the rental income you can adjust for inflation. With Bitcoin, zero management cost. Hold your Bitcoin in a wallet, doesn't cost anything. Zero insurance cost, although you can pay to insure it if you want. Capital gains tax, you can get around through putting the Bitcoin in trusts or tax efficient wrappers if you buy in the ETFs, which will increase the management cost a little bit. Upgraded for free by the world because it's a digital product. It's liquid, it's fungible. You can trade $10 of it on a Sunday night, right? It's very, very low cost to trade. You're talking about 0.1% as a trading fee. It's digital, it's quick, it's fast, it's easier. It can pay an income. Bitcoin doesn't pay an income because it's money, but you can use money in a certain way. Housing doesn't pay you money either. Your money, your house, if you're living in one now, doesn't pay you anything. It just sits there. It's only when you rent it out do you get an income. Or you can rent Bitcoin out as well. There's many ways to do that. So there are many ways to earn from BTC. There are many strategies to implement. Bitcoin, right, is that type of asset, and it has many desirable qualities. Looking at Bitcoin versus these other types of monies, it just simply has many more desirable assets than those. And so it's desirable for many people. Because Bitcoin is treated by many people as a savings technology, where they buy it with some of their spare assets, save it, you can think of it like an index, a financial index. The reason Bitcoin is a financial index is because it indexes the people that are using it to store and spend value over time. And there are millions of people that do this in different countries, with different income brackets, with different needs, saving at different times, saving different amounts. And so what you're doing, if these people spend and save Bitcoin, some part of their value that they have, you are indexing them, right? You're saying that when you're invested in Bitcoin, the price of Bitcoin is an index for the financial health of everyone that uses it to store and spend value. And because it's fixed in supply, we know that that value is going to be an accurate representation of what people are earning and the value of their output over time. And so it really is unique in that respect. There are other financial indexes in the world as well, where we can index economies. And what an index is it just is a group of things together and you can trade it easily. So the most popular examples are, this is the SPY, which is the S&P 500, which is the top 500 companies in America. You just buy the asset, you index those companies. Great way to index the economy. You have the NASDAQ, which is an index mostly tilted towards technology companies in America. So you buy the NASDAQ, and what you're doing is indexing technology companies in America. What are you doing when you're buying Bitcoin? You are indexing everyone who owns it and uses it to store and spend. So it's much more diversified as an index than pretty much anything else. It is a world economic index, and it's growing over time as more people adopt it and store and spend value. It will grow with the economic output of its users. During recessions, when people get worried that they will lose their job or that their income will reduce, and they are worried that they have liabilities to pay in the fiat currency that they're paying those liabilities in, they will sell their assets to get fiat currency to fund their liabilities. Therefore, in a recession, you could say the Bitcoin price may go down. More people would want to sell out of it to get fiat currency to pay their liabilities. In bull markets, when the economy is growing, people are earning more, people are feeling more confident, they have more money to store away, because that is a bull market, right? That's when the economy is growing. They have more money to store away, and so they put more into their assets, and you have more buyers there, which may force the price up. Cycles, but the secular trend of Bitcoin is clear that more people are using it to store and spend value over time. It will rise and fall with economic cycles. Bitcoin is the index. It is the world index. There is nothing that comes close. This is Bitcoin versus other indexes. This is Bitcoin in orange, the NASDAQ in blue here, the S&P in red, and gold right here in this kind of gold color. So it's very clear that Bitcoin has outperformed everything, as you can see over time. You can see Bitcoin's price here. These are the other ones right here. Now, it's unfair to compare them because these indexes are indexing things that have been around for, decades in terms of NASDAQ and S&P. And of course, these are broad indexes that index the largest, most mature companies in the economy. And so these are great, absolutely amazing to index those companies to save your money over time, because the companies are producing the value in the economy that we want to get exposure to. We want to index that. Great. Bitcoin does that too. Now, what Bitcoin has is its own growth as well outside of that index. Of course, the growth is what we're interested in, but over time, as Bitcoin matures, it will be that index, and its growth will slow and its returns will slow over time. But for sure, what we can see is Bitcoin is an index just like the other things, and even broader than those. Bitcoin is a financial index. Bitcoin is a strong digital asset that cannot be debased or tampered with. Bitcoin is digital property with a low barrier to entry. The Bitcoin network is strong and resilient. Bitcoin benefits from technological upgrades. It's tied to the real world. It is not a platform. It is not a technology company. It is not an enterprise. It doesn't do anything. It is just a digital money, digital capital with a fixed supply, and it's non-government, non-centralized, non-controlled. That is desirable for some people. They may not put 100% of their money in it, but they may use it in some cases. It may be beneficial for them in some way. If you want yield, then you have to take your BTC and do stuff with it. Money doesn't pay a yield. Cash doesn't pay a yield. You have to invest in a bond to get a yield. Same for Bitcoin. If you want to earn a yield on Bitcoin, you have to lend it to someone or do something else. And you can make a decision whether that's right for you. Bitcoin is property that gets upgraded for free and is not controlled. So it is a desirable asset in many different ways for many different people. Some people may not see any desirable characteristics in that at all. Let's now look at crypto's adoption then, because what we need to know is the crypto being adopted? Is there a secular growth? If there is, we can invest, we can trade, we can take advantage of cycles. So very quickly, we can see crypto adoption over time. So this is the Bitcoin chart, and we've seen this already, but what you can see is essentially crypto is being adopted. Price cycles, like I said, but adoption of the network. This is Bitcoin's network growth. So down here you can see these are addresses with a non-zero balance. If there are more addresses, that means there are more people and more activity. It's not one address for one person because you can have multiple addresses, but what we can see is activity and people coming over time does, over time, relate to the price of BTC. So these are, if you look at the orange lines here, addresses with non-zero balance, right? Price moves in cycles around the actual adoption of the technology. This is not an investment in a company or something or an enterprise that produces value. This is not what we're trading with crypto. Crypto is different. It's not a stock. It's not investing in Google or YouTube or anything. It is an investment in a network, like a telecommunications network, like the internet. But this time you can actually invest because it's a monetary network, and money simply is a network. So price cycles, but the adoption is very clear. If we relate the adoption that we've seen so far to the future, you're looking at way more growth in the Bitcoin price with cycles in between. This is growth models of the internet and the mobile phone. They're put in line with what Bitcoin has done over its price, over its history. Price moves in cycles, but Bitcoin's real adoption in relation to its address count has followed a similar pattern to the internet and to the mobile phone because it is a monetary network. It's a network that's proliferating over the globe. And so we should expect that to continue at some pace. We don't know if it's going to, go along with the mobile phone or if it's going to tail off, but the growth is pretty clear. We're investing in networks. We're not investing in a company or anything like that. This is a network that we're investing in. So what we can see here is growth as well over time. Now, what I do with the Crypto Investor course is update it for free. So check the link below if you want all the free updates. Existing users get it for free. So if you're in the course, you get all of this. This shows all of the data, in real time and my latest research on, are these things actually growing? So you can see Ethereum here. We're looking at Ethereum's growth, users, accounts, right? Everything like that. So keep real-time updates of what's going on here, and that's important for investors, right? So that's part of the crypto course. If that's interesting to you, you can just check the link below. But right here we have the adoption curve of crypto. This is crypto, not just Bitcoin. So in white, you have global internet users, which happened before, and they've put crypto adoption over the top. And as you can see, millions of users. We're actually tracking a very similar rate to the internet. So what you're doing here is really just investing in networks that are growing massively over time and have that secular growth. And so we're nowhere near the end of this. So as long as we know that these networks have this growth, we can just relax because we know that the yearly average growth is 30% according to this in actual network growth value. So whenever the price draws down, that's a great opportunity. But if we just invest and wait, we're getting really amazing growth way above most other assets. These are adoption curves. Again, we're investing in a technology here. It's not a company or anything like that. It's very, very different. So we have to treat it differently. And we can choose the amount that we want to invest in our portfolio. But you can see many different technologies here: televisions, VCRs, internet, broadband, radios. They have a big adoption. And then, of course, once they reach worldwide adoption, of course, you can't grow anymore because there aren't any more people. Well, Bitcoin and ETH have had fantastic adoption in terms of their addresses per capita, per person in the world. And of course, they're going to start slowing as every network does. Facebook had huge growth and then tailed off, but still had very, very good growth. So we're not in the early days anymore. No way. But we're certainly in that kind of early mid phase where there's still so much growth ahead. And we can just very easily take advantage of price cycles if they happen. But we're investing in technologies here and not companies. So we're not looking at P&Ls or profits or anything. No, this is an adoption story. This is what we're investing in. It's Metcalfe's law. And Metcalfe's law states that the financial value or influence of a network is proportional to the square of the number of connected users. So two telephones can make one connection. 5 can make 10 connections and 12 can make 66 connections. As more people join the network, it becomes exponentially more valuable because they join the network, you can communicate with them. That is what we're investing in. We're investing in networks over time. And the networks, if they're growing, we can be super confident to invest in these. As an example, this is the Ethereum network, which is growing. So this is something I discuss in the course as well. But what we can see here is you can see this red going up here. So this is activity on the Bitcoin network, on the Ethereum network over time, and the layer 2 networks, which are scaling it up to more users, cheaper transactions, more users. You can see what's happening, right? There is a proliferation and a growth of this network. So we're investing in networks. These networks are being adopted just like other technologies, and we're still early on in the adoption phase. Now let's come to altcoins and how they fit into this entire industry, because Bitcoin, of course, is the leader and it's the reason for everything else in this industry. And many people back in the day would, of course, call everything other than Bitcoin a shitcoin. And that makes a lot of sense if you know the kind of culture that was happening around then, which was Bitcoin was invented and clearly a very important invention. And people wanted to change it. Right? Bitcoin is fairly slow and it has 10-minute block times. And there were many people that said, look, we need this to be quicker. We need to change it. We need to make the blocks bigger in order to get more transactions in so we can, scale up the network. And people tried to change Bitcoin. People tried to copy Bitcoin, take the code and manipulate it. Well, all of those copies have failed, right? So if we look at the, CoinMarketCap rankings, Bitcoin is number one. All of the Bitcoin copies that were made, Litecoin is it's kind of its own thing, but you have, Bitcoin Cash, Bitcoin Satoshi's Vision, and loads of others down there. They have clearly failed against BTC, right? They are losing value over and over and over again against Bitcoin. And they were originally the things called shitcoins. However, in the modern era, you now have these projects here that just, are not trying to be Bitcoin. They're not trying to be a different Bitcoin. They're trying to be their own thing. And they're trying to use cryptography and these platforms to bring useful things to us. And so I think calling these shitcoins is obviously dumb, firstly. And secondly, it just means that you haven't you haven't spent any time researching what is the use case of this. Is it useful? Is it a thing to invest in? So look, Bitcoin is always going to be the leader for many reasons, but there are other use cases for this technology as well. And so let's go through some of those. So really, in the modern era of crypto, what we're really looking at is smart contract chains. And then on top of that comes all of the other stuff. So Bitcoin was invented to send Bitcoin from one wallet to another, and that's kind of all it does. Now, there are other things you can do with Bitcoin. For example, recently, ordinals and inscriptions have been being used more. And these are ways to put extra pieces of data in the block along with the transaction. And so if you can include data in a transaction, it means that you can include other things other than just sending Bitcoin. For example, text. And if you have text in a block, in a Bitcoin block, it essentially means that you have inscribed something on the Bitcoin blockchain that will be there for the rest of eternity, as long as Bitcoin is, a network that actually survives, right? So it's a little bit like cavemen painting pictures in caves of the things that were around them at the time, right? That was the way that they could have a memory of that. Well, if Bitcoin is a blockchain, basically a decentralized database, then you can put things in that database. Now, that has a specific use case because you have to pay for this. So maybe things that are really important, for example, history or other articles could be inscribed on this chain. And so that makes the blockchain obviously more valuable because you have a reliable database that can't be tampered with, and you put things on it that are really important for humanity to keep a record of. So that's a use case that comes out of Bitcoin, but it's not just sending one coin from one wallet to another. And so there comes ideas, right? Humans have ideas and entrepreneurs make things to, try and make money for themselves, and hopefully through, capitalism, provide things that are valuable to the rest of humanity as well. So what this all comes out of is that Bitcoin is slow and you can't change it. And that's good. But people want more expressivity with the products that they have. Now, Bitcoin is very non-expressive. It's very difficult to really include any data. moving up the scale a little bit, you have Ethereum, which tries to be more expressive. And so you can write in different things like smart contracts, other types of tokens, right? And then you come maybe to other ecosystems that want to be even more expressive still. There are many minute details here that I just can't get into, otherwise the video would be 15 hours long. But essentially what the industry has become is a base layer down at the bottom. And so that base layer does a couple of things. It hopefully becomes distributed as a computer system so that that blockchain is reliable and trustworthy. And if it's not reliable and trustworthy, it's literally worthless, right? Because you just can't keep anything on there, right? That's why we don't keep money, on these centralized players like Google and Amazon. It'd be very easy for them to come up with like an e-money system, right? We have these e-money systems like Cash App or whatever. Like, it's not difficult, but the invention of crypto is not centralization, right? If you have an e-money like Cash App, they're centralized. They have their dollars in the bank and you can send them around. That's not the invention of crypto. The invention of crypto is to have a decentralized system. So the base layer down at the bottom is really just decentralized network that allows you to code certain things into it. And so they will have slight differences, but really that is smart contracts that enable people to, enter into an agreement with that protocol, and no one else can change that when they enter into that. Tokens that come on top that can, make better use cases, right? So you can issue stable coins, you can issue exchange coins and DeFi coins and everything else. But at the base layer, you have that system. Now, there aren't many of these. And the reason is, once you have a couple of genuinely decentralized neutral networks, you don't need any more, right? Because you have one already. And so there's a few of these, and they seem to be large. If you look at the crypto market cap, these really now take up the bulk of the industry. So all I want to say here is that Bitcoin and Ethereum, these two coins, despite there being, you can just see this here, despite there being 12,000 coins in existence, Bitcoin and Ethereum take up 80% of the value of this industry. So that really tells you how mature crypto is. It's not very mature, but also that once you have a genuinely decentralized and neutral network, you kind of don't need to use anything else, right? Once that's invented, then as a business person, as an entrepreneur, as an inventor, whatever, you can't invent that again. And so you have a couple of these that just simply are going to be very big. And then the industry matures by building out stuff on top. So the base layer down here, and these are kind of the main ones that have most of the value in the industry. So as we come down, you have BNB, Solana, XRP. It's a little bit different, but similar thing. Cardano, Avalanche, Polkadot, Tron, Polygon. And that's kind of it. I mean, there's a few different ones here that have launched recently, like Near and Aptos, which really are trying to be something different again, much more specific. So when you have these large kind of generalized decentralized networks, there aren't that many of them. Now, on top of that, you have scaling and other types of infrastructure. And so the difference here is that this base layer, this asset, is a different asset than these, right? And so it's going to earn money in a different way. It's going to have a different value, and it's going to have a different type of longevity. We hope, right? Because if you have a large decentralized network, very large, very big, that's different than these, which are more specific. So these networks, they really need to be secure first, which usually means slow and expensive as well. But of course, that's not a great use case. That only has a specific use case for money and a store of value, which Bitcoin is. So on top of that, we try and scale out those layers to make the use case scale to more users, because you can't just use a Bitcoin blockchain. It's too expensive, right? And so we try and scale that out in different ways, or through Ethereum or through the other chains. So I haven't put Bitcoin here because I just think it's kind of different to these. But Bitcoin, if you had the Bitcoin base layer here, The layer 2 on Bitcoin would be the Lightning Network. So the Lightning Network is trying to be a scaling payments layer, and it's difficult work, but it's got some trade-offs, but you're trying to scale that payments layer. So for these smart contract chains, that happens as well, because you can't just put everything on the base layer, because there would be too much data to store. And if you have a lot of data to store, it means that only rich people or corporations can do that, and then that obviously centralizes things again. So you have to keep that base layer small and lightweight, and then on top, you try and scale it out. So as you can see here, for example, Ethereum, that scales out through many different networks on top. So you have these layer 2s. What these do is they sit on top of Ethereum and they batch up transactions. And so let's say they have 1,000 transactions on that network. Instead of 1,000 transactions going to Ethereum, you have 1,000 transactions on the layer 2 network, and they batch them all up together and send them down as one transaction onto Ethereum. And so they're paying the Ethereum fee, which is slightly more expensive, but they're spreading it out over 1,000 transactions, or however many it would be. And so that's a way to try and scale. And so you get these scaling and infrastructure layers, right? So there's many things that you need for a smart contracts chain, because you have contracts, which means you have price feeds, which means you have other data feeds, which means you need lots of things working together to make sure that everything is accurate for contracts to be agreed and obviously gone through with. So you have scaling layers like this, which can scale out blockchains. You have oracles. Now, oracles take data from other parts of the world. So from TradFi or from other blockchains, they take that data and they feed it out to the blockchains and all of the applications so that they can have these price feeds. How would this make money? Essentially, you're charging a fee for that data, right? So if you're a blockchain or if you're an application and you want price data, you have to pay a service provider for that data. And so that's where the money comes in. So I'm switching into how to make money now, because this is really just enterprise, entrepreneurial businesses, right? That's what they have to be. So really, they're not money, right? They're not decentralized assets. They're much more centralized at this layer. And so they're really just kind of businesses that need to make money, right? So these guys make money by, taking a kind of percentage profit of what they charge their customers and what it costs them to settle down to the base layer. Something like Chainlink and Oracle would just charge people fees for its data. Polygon is layer 2s, other types of chain development kit, bits of infrastructure that other networks or applications can use, and they pay a fee for that, right? You have companies like Binance, which develop infrastructure in a lot of different places. But again, everything has to be a fee or a payment, right? And there has to be money to be made and profits to be made, right? You have Coinbase as well here, which are building out layer 2 networks on Ethereum. So how do they make money? Again, they're a layer 2, so they're making some money out of that difference between what they charge and what they pay. But also, they're going to be making applications on their chain. And of course, Coinbase, as a public company, is going to be investing in venture. So, dApps, DeFi, other applications that make money, they want to be investing in those, taking fees from customers, and they need a blockchain to do that. And of course, they want their own chain. You then have things like Anchor, which provide RPCs, which is how blockchains communicate with wallets and everything like that. You have decentralized storage solutions as well, like Arweave and Filecoin, and also BNB Greenfield, which do things. Again, these are businesses that have to kind of charge a fee, right? And then you have cross-chain bridges like Stargate, which charge a fee for you to send crypto from one chain to another. So I don't want to say these are good or bad or anything like that, but I just want to differentiate between a base layer asset and then everything else, which is just a business that needs to make money. And then on top of that, you just have this massive proliferation of applications. So how can people take advantage of the ability to send value across the world, peer-to-peer, without any intermediary, right? And so what is the use case for that? So that spawns DeFi, decentralized finance. So you can trade, you can lend and borrow, and you can create derivatives. So, in the financial world, derivatives are absolutely massive. So these are futures and options. So if you are someone that has, produces wheat, you want to sell that. So you want to sell your crop now that you haven't, you haven't harvested, right? You're selling in the future. So you want to lock in money for your crop now. You can do that if you want through futures or options. And so all of this can be done on these networks as well. Staking as well, which is proof of stake blockchains will pay staking rewards because they earn fees and then they pay the fees out to investors. And so you have infrastructure players here like Lido, Stader, Binance, and Coinbase do this as well, right? So what are they doing? They are providing the staking infrastructure. They receive the fees from the blockchains and they pass it back to the investor and they take a small fee. So everything here is business. NFTs, of course, we know how that's something that you can put on blockchains. NFTs and ordinals are similar, but of course, a non-fungible token is one of the inventions of blockchain, and so you can have exchanges, other types of protocols that either let you create them yourself or trade them or whatever. Then, of course, gaming, because these networks now can use money. Right now we have stable coins and other types of money that we can use within games. You can either win actual money in games, or maybe there can be, social networks with that as well. So there's lots of different ideas here that spawns from having, money on chain, value on chain, right? This is all value on chain, right? Because this is what Web3 is Web2 is a few companies that ran databases that were read and write, and then they keep all the data. But now this is the proliferation of no one owns your data. It's all on the blockchain. And so we can move value around. And so all of this is just moving different things of value around, right? And so you have DePIN, which is decentralized physical infrastructure network. So what they're trying to do, this is Render, Helium, World Mobile. Binance runs a lot of infrastructure here as well. So what they try and do is meet buyers and sellers of something in the middle, right? So you have these guys which try and run small scale networks in telecommunications networks. And so if someone has Wi-Fi that they want to sell, or 4 5G that they want to sell, if they have a mast, they can sell that to people that buy the network, buy that connectivity. And of course you have money that can very easily transfer between them, right? Ordinals are the same thing as NFTs, more or less, like I explained. Then you have stable coins, which are probably the #1 use case of crypto. They're definitely the most successful use case right now, the largest use case. And these are simply fiat currencies on the internet. We've never had that before today, which is crazy to say, right? When you buy something online, you're paying with a card. It takes a week or more to actually settle with the banks. It's a complete nightmare. Well, now we have pretty much instant settlement of money online through stablecoins. And people don't really want to use these to pay for things. These base layer assets have become assets because what they do is they charge a fee for security and hopefully make profits and then pass that back to investors. So I would say these are crypto assets. They're not money, in my opinion. They're not money, they're not currency. No, they earn fees, pass them back, and so they're an investment, right? And so people don't really want to trade those around and spend them for stuff. That's not really how people behave. And secondly, these are going to be taxed if you get rid of them. If you sell them, they're probably going to be taxed in your country, which makes it just unfeasible to use them as something to spend. And so these are investments, but these are currency on the internet. And so obviously they're going to be one of the biggest use cases, right? Because you can now send money around. Now, if you look at Tether and Circle, these are probably the most profitable businesses within this entire industry, because what they do is they take dollars from their customers, who are mostly institutions. So an institution will give them $1 million. They will issue 1 million units of Tether, 1 for 1, of course, because it's $1 in a bank for 1 USDT. Now that stablecoin is online and it's circulating on any of the chains that they operate on, which is most of these. Now, what Tether actually do is they take that dollar and they invest it in short-term government debt, mostly US debt. I think it's all US debt now. Money market funds, very, very short dated, like, 1 month, 3 month bills. Now, those earn yield for Tether, right? So they have an amount that they're making on whatever the circulation is. So if you look at Tether, the circulation of Tether is 95 billion. Call it $100 billion. So Tether as a company have $100 billion worth of client money, and they're investing that in short-dated government debt, which let's say that pays around 3%. Well, they're giving 0% back to their customers because this thing doesn't pay yield. So essentially what Tether are doing is earning 3% on $100 billion and not giving any of it back to their customers. Now that's really good business. And this is what USDC do as well. Now, what's happening because competition is that now you have stable coins that say, wait, hold on. What we'll do is actually pass that yield back to you. So this is where USDM comes in. It's one of the new ones. Again, I don't want to promote any of these coins at all. There are many, many risks in owning crypto, especially coins that are issued by centralized issuers. These aren't decentralized at all in any way, right? None of this is decentralized. These are companies, right? These are, created by and run by people. But I just want to show you the outlook of the industry. So something like USDM, essentially what they do is you give them $1, they will invest that dollar in short-dated US treasuries, and they will actually pass the yield they get back to you. Now they're going to take 50 basis points or 20 basis points, whatever it is of the yield, as their fee, which is fine because that's what money market funds do anyway, right? They'll invest anything and they'll take a small fee out, obviously, because they're running a business. So now you have competition. So now what we have potentially is the ability to hold fiat currency online whilst always receiving the risk-free rate. Now the risk-free rate is something that we call the base rate that you can get if you invested that fiat currency in the government debt. So US treasuries, if you have $1, right, cash, that's not earning any yield. If you have $1 invested in treasuries, you might be earning 3%. That's the risk-free rate because the government is never going to default on its debt because it can print money to pay you back. We won't get into how they do that or why that's actually a bad thing. But if you're getting cash with 0 or a US treasury with 3%, which is basically the same thing, you'd rather the 3%, right? Well, that's what these are enabling. So you can essentially own dollars and receive the risk-free rate in your account like a checking account, and you can spend them out whenever you want. Now, if you contrast that with a bank, you're going to have to put it into a savings account or a CD or something else where you may have to lock up your funds. So these are one of the most important inventions coming out of these chains that allow for value transfer worldwide. Visa are starting to use blockchains as well, and testing it out for payments as well. So stablecoins are important. Now, we can't really invest in these. Tether is a private business. Circle is private, but as of making this video, maybe going through an IPO. So these are going to be stocks listed on the market. So you can't really invest in them, maybe if they're public companies. Then, of course, with value transfer or data transfer around the world, that spawns experiments with social media as well. So you have Nostr here, you have Farcaster. Nostr is Bitcoin-based, Farcaster is Ethereum-based. This is where you can actually keep your data online, on-chain, right? So let's say you have a decentralized ID, which is a DID, decentralized IDs. You keep your data, you keep all of the stuff that you post, including messages between friends, you keep that yourself, and you can bring that data to any client that you want, right? So rather than now we have Facebook, if you use Facebook, all of your data is owned and on Facebook servers, and your history and everything, you can't take it with you anywhere else. With blockchains, the potential is that you can have your data associated with your wallet kept on the Ethereum chain or maybe layer 2s, and you can use any client that you want. So if client ABC, you don't like the design or they change something, you can just take that to client C and all of your data and history just moves over, and now you have a new interface. These are, very, very new and experimental, but obviously something that seems pretty important. And then what is very important is decentralized IDs or DIDs. And we're going to have these more and more, which is our ID, right? So we can put our ID in these, and it has certain things about us that these applications would need to know. For example, what country are you from? Because some assets you can trade in some countries, some assets are blocked, some laws prevent you doing certain things. And of course, right now, we can do all of that on chain without any issues. In the future, it's pretty clear that governments aren't going to like that. And so what they're going to try and enforce is decentralized IDs, where you can actually put your kind of ID info into this DID. Now, the advantage here is that essentially you can prove to applications something that they need to get proved without revealing the actual information about you. So for example, if I want to trade something on a DeFi app, and there are certain restrictions based on your country. Well, with your DID, you can prove to the application that you're from a certain country without revealing your name or your address or where you live or your phone number or your ID card with your photo. So you can just say to the app, look, I've got this DID and I'm from a country where I can trade. And they say, okay, no problem, we'll let you in and trade. You don't have to reveal your info. And that can work across many different things as well. So it's an upgrade to the current system. So that is an overview of kind of the base layer and then everything, on top, which is basically a business that tries to make the use case better and bring it out to more people. With altcoins as well, we have to discuss staking. Now, Bitcoin is a proof of work network. You can't stake your coins on there. And the reason why Satoshi made it like that is to differentiate owners of the coin from operators of the network. It's a very, very important distinction to make sure that the network itself remains credibly neutral and competitive, and that the owners of the coin can't own a lot of them and then control what the network does. And it's a kind of differentiation or a split, a separation of ownership and control. And the network is designed to make sure that no one has control and there's no staking. If you want to earn Bitcoin, you have to work for it. You have to put out work yourself and earn fiat currency and then swap it for Bitcoin. Or if you want to mine Bitcoin, you have to work for it. You cannot create it yourself. That's very different to altcoins. And that's why they always are compared to equity, or otherwise known as securities. It's because human beings can snap their fingers and create them. And Bitcoin cannot be created like that. You have to work. And there is a big distinction between that. So let's look at altcoins and staking and inflation and what all of this is. So tokens have inflation, and that means they start off in a very small amount. So they'll start off with 100 million tokens and they will inflate. That is, the protocol will create new tokens every day or every 5 minutes over a period of time to come up to some number in the future of something else, 10 billion. Like Solana actually doesn't have a cap on its supply. It just says, at the moment anyway, that its inflation is going to be eventually, it's around 6% right now, but the inflation will come down, but it will be 1.5% in perpetuity. Now, they may change that in the future or not, I don't know, but that's what it is now. Why? Why are they inflate? Why is the token inflating? So that comes back to how these altcoins exist and why many Bitcoin maxis, of course, call them shitcoins because they don't see them as money. Now, these aren't money because they're created by humans and they are sold to investors. So that's where it gets a little bit more a gray area. So you have a token at the start and you have 10 million tokens or 100 million tokens. You sell some of those to investors. Why do you have inflation? Because you need to pay for stuff. So a project, a blockchain project is, a group of people that are doing something, and they're doing that because they want to earn money. They want to earn money by creating a network or creating an application and charging you fees for that, right, to use it. So the inflation comes in because they can't just have all of these tokens out there initially, right? They need to have them over time because, of course, they want to feed them into the market over time to fund their growth. So the initial amount, they'll have that, they'll sell a bunch of it to early investors, keep some for themselves, right? And then over the next 20 years, you can see the inflation, right? It just starts to go, it goes higher and higher and higher. So every 5 minutes or every block, that will come in with some new tokens. Who's owning those tokens though? Well, it's the people that own these. These people own a certain percentage of the protocol. And when you stake that token, you get the staking rewards, which will be paid out. If you're early investors, you may also have specific different lockups. For example, you can see here that some protocols, what they do is there'll be early investors that are promised more tokens over the next 5 to 10 years, and they get those tokens, every week or something. Well, that's adding more tokens into supply, which is inflation, right? So essentially why inflation exists is because you have investors that want to have those tokens given out to them for free so they can sell them for money. Now, that can be fine or it can be nefarious. The first one is you're a project, you have no money. So you need to sell the tokens to get dollars to pay for the project to get built and to pay for developers because they want actual money. They don't want these tokens, they want dollars so they can pay for their house. Over time, you know that you're going to need to stay competitive and have even more money in your coffers to pay for even more development. And so you take these types of things where you get staking rewards that come out to you 5% a year. So you know as an early investor or a project that you own 30% of this project and 30% more coins or 5% more coins are going to be coming in every year for you that you can use to sell for dollars to fund the project or just sell and now you're rich. So that's why token inflation exists. It's the same as equity, right? If you've ever been in a company that has done a share placing or sold equity to investors, they're creating equity out of thin air. They're selling it to you for money because they want to expand their business or do something like that. Or, what happens in larger companies is that CEOs and managers will get free stock options, which means they have options over stock so they can buy them cheap and sell them for what the market price is. And that's like a remuneration package for them. So you can see the mix here between, these aren't money. These are some sort of like equity investment, but they're not equity. They're tokens. They're definitely not equity. They're tokens, but they have a mix of this kind of equity thing in them. So that's why inflation exists. You need to pay for development over time. And of course, you need to pay for security over time as well, because you need people to stake. Inflation is a bad thing, right? Inflation means that your percentage ownership of the protocol is getting diluted all of the time by inflation, just like the US dollar is. So inflation isn't good. It's something bad, and we need to protect ourselves against it. Most tokens will have inflation because that's how they start out. They start out small. They need to bribe people or pay them these tokens to get them to do stuff like join the network and stake, right? So it's not a good thing. We need to make sure that we aren't in a token that has very high inflation. It's just debasing our currency all the time. So some tokens will cut the inflation off that have it now. For example, Bitcoin and Cardano. Cardano and Bitcoin have a cap on supply. Bitcoin is 21 million. Cardano is 45 billion. And so they have inflation as the network is growing, but their outcome eventually is we won't create any more coins. And we have to make sure that the network is profitable enough through fees to secure itself, right? So that's their thing. Some tokens will never reach maturity and they will simply devalue, right? Because they have inflation, the fee generation isn't enough. And so they're just going to inflate over time and become less valuable versus things that are more valuable, more popular, and have more fee revenue, right? Now we are entering a stage of some maturity in the industry where some projects are very profitable. So for example, Ethereum. Ethereum is extremely profitable. It makes a lot of fees as a network. And what it does with those fees is it returns a lot of that fee revenue to investors in Ethereum, where you can stake your coins in the network to receive the fee revenue. And so what happens is, you can see that here, this is buybacks and dividends. So just like a business which wants to create shareholder value through its profits, it has a business, it earns profits, and it takes the cash that it has, which is worthless, and it buys back its own stock. And that takes money that it earned and increases the value for shareholders because it buys back the stock. And so it buys back and cancels the stock. And so now there are fewer shares sharing the value of the business that pushes the share price up for each of the remaining shares. That's what Ethereum does as well. That's what BNB chain does because it's profitable, and a few others. So that's a share buyback, but you call them a token burn in crypto. It's the same thing. Now here, you can't see it, but it's right here. It says dividends. Companies pay dividends where they just earn profits and they got nothing better to do. So they just pay you cash. And it's like, we made this money, here's some of it, right? And you can do what you want with that. You can either roll it back into the stock or you can take it out. The way that crypto tokens do this is through staking rewards. So let's say Ethereum is earning, billions of dollars in fees. In Ethereum, the gas fees are paid in ETH. And so what it will do is just pay some of that out to people that stake. So what can happen is, after a month or so, you will have more Ethereum in your account, more Ethereum in your staking account. Now, staking Ethereum you can do with different organizations. We won't get into that now, but essentially, if you are staking ETH, you'll be receiving more ETH, right? And so that's like a dividend out to investors. So again, you can see there's a lot of similarities with equity here, but Ethereum definitely isn't an equity. It's a network, it's code, right? It's definitely not, but there are many similarities. But the underlying is that, value is returned through a very simple method, right? If something makes money, you have to return it either through reducing the supply of it or just paying out the cash that's made. And we call it token burns and staking rewards. Inflation is used by early investors to dump on you. So what happens now in crypto a lot is that obviously everything is venture capital funded. Now, venture capitalists, what usually happens is they'll put money into a business or something else, and then they'll have a lockup period of like 5 years. That's very common. What's happening now with crypto is that they actually don't care about that because they can have staking rewards. So let's say you have 30% of a project, and let's say that's $100 million. And let's say you're locked up for 7 years, and so you can't take that out. That's not great for you as an investor because you've got money locked up that you can't sell. But the staking yield is 6 or 7%. Well, that's a way of getting money out of the project because you're now making 6 to 7% on $100 million paid into you in fresh tokens and cash. You can actually sell that out. So yeah, inflation is used by early investors to dump on retail investors who are sold tokens for some reason. Hey, look at this shiny new token. You're going to get rich if you buy this. Meanwhile, you buying it is through the supply of early investors who are selling out their staking rewards. So that's something we have to be aware of as well. What we need to look at is fully diluted valuation. It tells us how much is left to dump on our heads. So let's have a look at this. Bitcoin has some inflation left, 19.6 million coins, 21 million total coins. So there's some inflation left with Bitcoin. If we look at Ethereum, you can see the circulating supply is 120 million, total supply 120 million. Ethereum is deflationary or disinflationary now because fee revenue is enough to sustain it. And so we're actually getting real rewards out of it. If you look to something like Solana, I think Solana basically has no max supply. As you can see here, it's infinite. There'll be at least 1.5% new coins every year. At the moment, it's around 6%. If you look at something like Cardano, 45 billion max supply, 35 billion in circulation right now. So let's go down to something like Polygon. You can see that Polygon is number 16 in the rankings. It's worth 8 billion as of making this video. And you can see the fully diluted valuation is $8.5 billion. That's pretty good, right? So what we know is that most of the supply is circulating, right? Because the market cap is 8 billion and the fully diluted is 8.5 billion. So we know that there's actually not a lot of inflation left in this coin unless they change the rules or anything like that. Well, that's number 16 in the market cap rankings with a valuation of around 8 billion. So if you come down here to something like Arbitrum, this is valued way lower than Polygon, right? It's number 38 in the rankings, not as big, obviously, not as valuable. It's only worth 2.6 billion. But if you look at the fully diluted valuation, it's worth $21 billion. So this project actually, when you take the total supply, is extremely highly valued. This would actually be like top 6 coin. Why? Because there is a tiny circulating supply. So we take the market cap, like I said, by taking the price per coin and multiplying it by the circulating supply. There, only 12.75% of the total supply is in existence. There are millions and millions of coins left to sell and dump on us. Why? Arbitrum is a new project. It's fairly new, maybe like a year or so old in the public market. They are new. There's a lot of infrastructure to build. And so they have a lot of tokens that are held up in order to dump and sell for dollars so that that project team can be competitive and build competitive products. It's not to say that that's a terrible thing. There's no other way to do it, right? You can only raise a certain amount of money when you're very small and you have no product. You can only raise venture capital at that point, right? Venture capital is like, here's 2 million per project. We'll put it in. And you know what venture capitalists are like? They'll spread that around. As a project that doesn't have a product, you simply can't raise more money than that. So you have all these tokens because you build the project, you make it a bit bigger, and then the value grows. Then you have equity in your token at that point, right? You have money now because people are willing to pay a higher price. And so you can sell to make the project even bigger. So this is how capitalism works, how venture capital and public markets work. You're seeing it in real time. But don't get caught out thinking that, wow, Arbitrum is really low valued here. It's not. It's worth $20 billion. And so they are going to have to really build out very important services to justify being valued at $20 billion fully diluted, right? So what we would hope is that as they sell out all of these tokens, give them out for projects and incentives and everything, this selling supply gets absorbed by buyers who are simply willing to pay the current price because this project is seen as profitable and good and big and sustainable. So something to think about when looking at altcoin valuations. A great resource is Token Terminal. You can see what tokens earn how much and if they're returning it to you. So this is one of the resources I'll link down below in the description. So Token Terminal, you can see 180 days here. Over the last 180 days, which tokens have earned money? Ethereum, number 1, you've got $1 billion here. So Ethereum's earned $1 billion as a protocol. Bitcoin is up there. We'll never return any of this to investors. That goes to miners. But it's a profitable protocol, and that's important for Bitcoin as well for its longevity. You have Tron here, Lido Finance, Uniswap. So all of these are essentially Ethereum DeFi, MakerDAO, Aave, Avalanche is its own chain, right? Curve Finance, PancakeSwap, GMX. These are all DeFi applications, right? So trading, investing, derivatives, things like that. They charge a fee for people to trade on there, and so they make money. Right, so they're good businesses, and they make, they've made $50 million, they've made $58 million. So there are some profitable businesses here. Obviously the difficult thing comes with the base layer assets, because these are not just businesses, these are not just profitable, these are also base layer assets, which means you can collateralize them, you can use them as a store of value, you can put them in protocols to get other things, right? So base layer is kind of a little bit different. But with the applications, these are just businesses in my opinion, right? GMX is a derivatives protocol. People trade, GMX charges a fee. How much do you earn now? And what is the valuation of your business? If your valuation, if your total market cap is anywhere from 10 to 80 times your revenue, that's kind of okay as a tech investment, right? These businesses will be valued very highly. 50 times, 80 times their fee generation would be normal because they're expected to grow a lot larger. They're not cheap. Some will grow and some won't. So again, it's difficult, which is why when people invest in equities, they diversify because they just don't know. When you diversify, what you're really saying is, all right, here's 20 of the best businesses in crypto. Let's just put all these into a portfolio. And that's, 5% of my portfolio, right? So you've got this, you're not investing in one thing, you're just investing in DeFi. You're investing in, crypto. And that's what you want exposure to. So what we have to look at also when doing that, I'll get to this in the investing section, but you need to look at, what one of these assets is performing against ETH. Because ETH is really a decentralized or kind of a diversified way to invest in everything built on top, right? Cardano is a diversified way to invest in everything building on top because they all eventually pay fee revenue. So a question to ask yourself is, do I need to invest in these altcoins? Or can I just get exposure to all of them by just buying the base layer asset? Everything's going to feed down to that base layer asset. And is that the sweet spot for me? Risk reward. It's bigger. It doesn't matter if 7 of these businesses fail because some other ones will come along and use the network, and that's fine for me. So there's just questions that you need to ask yourself when going into altcoins, but Token Terminal is great. You can see exactly what each of the protocols earns. Now a quick note on staking, because if you own any of these coins that aren't Bitcoin, they probably allow you to stake. And so what is staking? Well, it comes in line with inflation, like I said. If you stake your coins, you receive staking rewards. Now, staking rewards come from 2 places. One is inflation, right? Which is the protocol just creating new tokens out of thin air and giving it to you if you stake. And the other is through fees, or more accurately, profits, right? If the protocol, if the blockchain or the protocol, whatever it is, that token, they're doing something, they're earning money, they're earning fees, and they're paying everyone, and then profits are made, that can be returned to you. Now, the way you do that with all tokens is through staking the tokens. So if you've got ETH, you stake Ethereum directly on the blockchain. There are many other providers that let you do that as well very easily. I've got specific videos on staking across all blockchains, so they'll be listed below as well. Staking, though, is sometimes mixed up with lending or DeFi. This is not lending or DeFi. Real staking is where you take the layer 1 coin, you stake it right on the blockchain. And so that is not lending or anything like that. It's a blockchain protocol that should, pay you back, right? Now, there are other things that happen with staking, including slashing. We won't get into that for this video, but generally, as long as your stake is with a validator in the network that is running properly, you should be receiving those staking rewards, whatever they are. So obviously, inflation isn't good, right? We know that inflation, that's not good to have. And what we want is staking from real fee generation. So layer 1 networks use staking rewards to incentivize people to stake because it's a security mechanism on the network. And so they need inflation initially for that. After they're mature, they should be generating fees and profits that actually pay you real yield. So what we know is staking rewards minus inflation is the real yield that we get. So staking rewards minus the rate of inflation is the real yield. So let's take an example of, we have 5% staking rewards for our token. And 5% of that is paid out through the inflation of new coins. So we're staking, we're getting 5% more each year. Our real yield is actually 0 because our new coins or tokens have been paid out to us through the creation of new coins. And so the net effect is that no one's got any richer. It's why inflation in fiat currencies makes them less valuable as well. Because you can't create real output by printing money, right? You can't do it. You can't create a doctor by printing money. You have to actually, educate them over 30 years. Real work. You can't pay real yield by creating tokens out of thin air. You need to have profits and pay them out to people from the actual work that you did. So if staking rewards are 5% and the inflation is 1%, then our real yield is 4%. We know that 1% of inflation is taking out, but there is some real yield there. So what we can also determine from that is that if you are not staking, but there is inflation in the coin, so let's say a coin that has 5% inflation every year, and you can get that 5% through staking, but you're not staking, you are getting debased by 5% a year, which is exactly the same as what fiat currency does. Now we come to a quick primer on trading before going ahead and actually seeing me trade live, so you can see everything and how it's done and how to navigate a screen like this. Currencies are traded in pairs. All assets are trading in pairs. You need to sell one thing to buy another thing, right? And so you need value. You need to spend that value to get the other thing that you want. This is an exchange of one thing for another. The way that we look at that and trade that is like this. So what we have here is BTC/USDT. What we're saying is we're trading Bitcoin against a stable coin, US dollar stable coin. We're trading Ethereum, ETH, which is the ticker of the asset, which is the 3-digit code or 4-digit code. And we're trading that against US dollar Tether. Or you can say we're trading Bitcoin against ETH. So you just need one, you need to sell one, and you need to buy the other. The base currency is the main currency that you're buying. That's on the left. So what you can see here, these are the base currency. The quote currency is the currency which you're selling. So that's this one. That's the currency that is using to quote the base currency. How that works is that it tells you how much of the quote currency do you need to buy 1 unit of the base currency. So you have the base currency, which is BTC. How much of the quote currency do you need to buy 1 unit? If we see a price that is this, BTC USD 50,000, we know BTC is the base. We need 50,000 USD to buy 1 unit of BTC. If it goes up like this, we now need 55,000 USD to buy 1 unit of BTC. The price has gone up 5%. The BTC USD pair is up 5%. That means the base currency has accrued in value by 5%. It takes 5% more of this one to buy the base currency. What we're doing when we're buying assets is we're selling our fiat. And so what you're inherently saying is that this thing that I'm buying will be worth more when I come to sell it next time, right? And so what you're saying is which thing are you selling and which thing are you buying? Because that thing you're buying, you think it's going up in value. You're basically betting on one thing versus the other. It's not just an investment in one coin, you're selling the other thing, right? So you're inherently saying that the thing you're buying is going to outperform the thing that you're selling. So yes, you could be selling fiat currency into Bitcoin, but you could also sell Ethereum into Bitcoin if you think Bitcoin is going to outperform over the time frame of that trade. Could be a week, could be 10 years. When you buy crypto with a fiat, you're betting against those fiat currencies. Now, fiat currencies go down in value over time. We've got hundreds of years or thousands of years of history of that. And assets go up in value. So that's a pretty good bet. It's pretty safe bet. I mean, as long as you're buying an asset, right? This is the most basic strategy. Currency pairs change though. When we look at cryptocurrency, we always quote the dollar price. So you can see here, Bitcoin's 46,000, Ethereum's 2,600, BNB's $300. But of course, many of us don't trade in dollars. We trade in other currencies. This is Bitcoin versus some assets. So this is against pounds. So it's gone up in value versus pounds. It's gone up in value versus euros to more or less the same extent. That's because pounds and euros have devalued versus BTC more or less the same extent. Except against Argentine peso, it's really gone up in value. And against the Turkish lira, it's really gone up in value. So it really depends where you're coming from, right? If you earn in pounds or dollars, then Bitcoin is outperforming those. But if you earn in lira or pesos, Bitcoin is extremely outperforming those. But Bitcoin's the same thing. So what these charts are showing is the weakness of the quote currency. Now let's come to actually how to navigate this as well. So on the trading screen, which you can get on TradingView for free or some of the crypto exchanges, which I'll go over in the next section. But we have a screen of two currencies. So up in the trading screen of a crypto exchange, I'm using Bybit here, BTC USDT. So what we're looking at is Bitcoin against US dollar. And we can see right here, this is the chart over time. So let's go to a week chart. This means that we're looking at each period in time to be a week. And you can see that over recent history, the price has gone up. What we're saying is it takes more dollars to buy Bitcoin. Bitcoin has accrued in value, right? How do we know that? We can see this as well. So this is the order book. This is the actual market for this currency pair right now. The order book is simply a book of orders. That's why it's called an order book. It's the orders sorted by price. So up here you have sellers, and up down here you have buyers. These are cheap, these are expensive. Where they meet in the middle, this is the real live price of Bitcoin. This is the price of Bitcoin that is actually being traded. People are selling and buying Bitcoin and USD. Down here, we have bidders or buyers. So the bid is the half of the book that is buyers. So we call this the bid, right? So they're bidding for Bitcoin. So if you're a buyer, you can join the bid and you can bid for Bitcoin. There is also the other side, which is sellers. This is known as the offer. These are offering out their BTC. If you're in America, it's called the ask. So you can offer, right? You can offer out your BTC. This is the ask on this side of the order book. So down here we have the bid, and this is the ask. In the middle, we have the actual price of BTC. Now, between the best bid and the best offer, so the highest bid and the lowest offer, that is different, right? If I was to bid $50 for something and you were selling at 52, the spread is $2. That's the spread between the best bid and the best offer, highest and lowest. The spread is the difference between that. This is a cost when trading. So when you buy, you're buying from someone who's selling, and there is a spread between that. Now for crypto, the spread is tiny. It's literally 0.01, as you can see here. So 1 cent, I think this is. There's a 1 cent difference between the best bid and the best offer. So it's minuscule. When you get to very, very illiquid coins, tiny coins, the spread may be bigger. And that is a cost, because if you sell and if you buy and sell immediately, you have to pay that spread, right? So that is a cost of trade. And then, of course, you pay commissions and trading fees. So every time you buy, you're already immediately down by the commission that you pay and the spread that you pay. Now, this is the trading screen. So if I were to bid, if I were to be the best bid for Bitcoin, I would have to pay 42,909 spot 40, right? That is the best bid. Where is the best offer? This is the best offer, 42,909 spot 41. On the right-hand side, you can see what is being traded at that price. So we know that the quantity for this is here. We know that at 42,909.41, there are around 6 Bitcoin on offer. So that might not be one seller, there might be multiple sellers, but that price has 6 Bitcoin on offer. And I think this is the total on the order book. Up here at this price, we have 0.7 of a Bitcoin on offer. Up at this price, we have even less. This doesn't matter too much because what happens with Bitcoin is that people hide their orders. They don't show their orders. They only show the order they want down here, and then up here they actually use, trading bots to put in orders if they get traded and things like that. So it's too complex for this, but essentially we're seeing the price and the amount at that price that can be traded. So you can look at that. Now, again, for BTC, 5 Bitcoin, is plenty of liquidity for BTC, right? But if you look at smaller pairs, you might be able to see that there's a price, but there's only a tiny amount here. And then the actual volume to be traded is further down. And that shows you that the real price of the asset, maybe not this, but maybe this, right? So that's how we read the order book. It's a book of orders and a book of traders showing their trades to the market. Now let's come to the top crypto exchanges. If you are looking to trade crypto or use blockchains, you're going to need these centralized exchanges as an on and off ramp, but they're not all created equal. So I'll just go through the major crypto exchanges right now. Some of the smaller exchanges are what's known as bucket shops. They'll let you trade meme coins and these small things that, are just kind of the bucket shop type of, investments. Others are much larger and provide big infrastructure for the industry and wallets and everything like that. Coinbase, one of the biggest names in the industry, they are the only publicly listed centralized crypto exchange. That means that they have their stock market listing, they are open and public, and there's an army of lawyers here making sure they don't steal your money, right? And so trustworthiness has to be the number one thing. All of the Bitcoin ETFs and the providers there, they're actually using Coinbase to go ahead and buy and custody things. So big business, trustworthy. Of course, things can go wrong, but having a public trustworthy company like that is definitely a bonus. Their products are pretty much inferior though, unfortunately. I've used them a lot and they just are a bit slow and clunky, not great to use. Binance is the world's biggest crypto exchange by a country mile. They're huge. They have massive infrastructure that they support many different blockchains and everything else. They offer pretty much everything that every other exchange offers and more. And it's a very, very good product. I use Binance a lot myself. I'll leave the exchanges I use down below in the description. I can't recommend any exchanges. I just want to give you the ones I use. Now, these exchanges usually give you a bonus or a trading bonus or a deposit bonus or something like that, right? So I'll leave details on all of that down below. You can see the bonuses or whatever. And for some countries, that's not available. For others, it is. You're going to have to look at the links and the details in the links to see if it's available for you. But these exchanges are businesses that want our trading volume because they charge us money, right? So as long as we get a good service for a decent fee, that's fine. Binance is amongst the cheapest. You get great access to pretty much everything. Now, Binance is pretty much banned from the US because they went into the US market and they let people trade without KYC, which is know your customer information. That's not good to do. They got an investigation there. They paid a fine. Every bank has paid a similar fine, but obviously Binance was investigated and their business is profitable. All funds are accounted for. So, it doesn't really taint them for me personally, but many people might not feel comfortable. So just putting it out there. Bybit is definitely centered more towards trading. They're all centered towards trading, but Bybit is really more for active trading. Big player outside of the US. It has huge chain support. You need chain support, right? Because you need to be able to buy a crypto and then use it and withdraw it onto the blockchain. And so you need a good coin support. Bybit has it. Binance has it. Good for trading. I use Bybit a lot too. Then we have OKX, which is number 2. Big in Europe and Asia. Very, very good for Web3 infrastructure. Huge chain support. Great trading options. OKX is actually a really great exchange with lots of different options. What are we looking for with a crypto exchange? Good fiat currency on and off ramps. Get money in and out easily. Some are better than others, and it's going to change depending on which country that you're in. So you're just going to have to check out, these specific services. If you want to know how to use the exchanges and the things that they offer, I've got specific videos which I'll link below. Spot trading fees should be around 0.1%, more or less, for a trade. So the volume, the amount of your trade in dollar terms, or the amount that you buy, 0.1% will be taken as a trading fee. If you trade futures and options, you'll be paying under that, or at least you should be. So watch out for the fees on the exchange that you're using. these should have very good network support. If I want to buy a crypto and withdraw it on the blockchain, they need to support that network and make sure that I can do that. All of the ones I've mentioned have great support. Coinbase, a bit mediocre with that, unfortunately. The others are much better. There may be other products that you can use here, like launch pools and earn products and everything else. These carry their own risk. These are investments. They may be banned in your country because it's an investment product and it may not be available for you. Again, that's going to change country to country. These have their own risk, and so we must know that. But ultimately, we need to trust that when we put our money in the exchange, they're not going to use it, they're not going to lend it out, and they're not going to steal it from us. And so trust is the main thing, and just please trust. Like I said, I cannot, advise on what exchange to use. The ones I use are pretty much these ones that you've seen. And so I'll link them below as well. You can check them out. If there's any offers or sign up bonuses, obviously that would be decent, but we must trust them. We must trust them. Now, the way that we can see that is what's known as proof of reserves. This is what the crypto industry did after all of the FTX thing, where each crypto exchange cryptographically proves that they have the assets that they say they do. And so Binance is number one. It's the biggest in the industry. You can see 75 billion in clean assets here that they hold for customers. This is cryptographic proof that they're not stealing your money and there's nothing there. So they all do it. You can see that Bybit, OKX, Binance at the top, Crypto.com, all of these. Cryptographic proof that they have their clients' assets. That is a must. If you're using an exchange that doesn't have this, just don't use it. They must be able to prove this, and this is an industry standard or becoming industry standard now. So the top crypto exchange should give you more or less these options. Now we'll look at how to go ahead and trade cryptocurrency and use this type of trading screen. So what I'll do is leave links to videos below for all the platforms that I use and how to use them. So how to get started, all of the different options and tools and everything really in depth. I'll leave those videos below. For here, we'll just get started with trading cryptocurrency live and some of the options. So the first thing is, if you have an account on a cryptocurrency exchange, you need to get money onto the exchange. So there's really two options. The one is card and the other one is a bank transfer. This is going to change depending on which country that you're in. If you go to buy crypto, up at the top left of most crypto exchanges, they're all going to be laid out the same, is you have an option to get fiat currency in and buy a crypto. So your fiat currency would be here. If you spend that fiat, you'll get to choose between buying some cryptos that you might want to hold. That's great, simple, easy. You pay with a card. It's going to be around 1 to 3% in fees, which is very high. It's easy, but it's very high fees. What a lot of people may do is use a specific on-ramp in their country to get a bank transfer in. Now, some crypto exchanges are fantastic for on-ramps. Some countries restrict this, so you're just going to have to work out in your country what the best options are. Some people use another on-ramp exchange to get money in and then transfer the money over to another crypto exchange which has much lower fees. So you put money in, you exchange it for Tether, USDT or USDC, which are stable coins, transfer those stable coins over, trade on the lower cost exchange. There's many different options here. It's up to the individual and what works in your country. So this is an option. And if you're using this option, just directly buy the crypto that you want to hold. The more professional way is to use the spot trading market. So we'll go to trade here, spot trading, and then BTC. And what a lot of people do is trade BTC against a stable coin. If your country allows you to put fiat currency on your exchange, go to the fiat currency market and trade directly into a crypto. So as an example, Bybit allows for euro trading. So if you put euros onto Bybit, you just go to the asset you want to trade, so BTC. So for euro, you can put a bank transfer in of euros and then spend those euros to buy BTC in the euro BTC market. So that's right there, and that's a fiat to crypto. If you don't have that option, a lot of people, especially if they've been in crypto a while and traded in and out of things, they will use stable coins. Stable coins are a crypto dollar, so a dollar stable coin. So you'll have a stable coin here, and that's the money that you spend to buy a crypto. So we'll look at Bitcoin here against US dollar Tether. See the price changes a little bit. This is a much more mature market. And of course, we're trading against dollars here and not euros. Up on any platform, you should be able to search for the crypto pairs that you want to trade. So if you type in BTC, you can see all of the crypto pairs and the ones with the most volume. BTC against Tether, BTC USDC, BTC Euro, and then BTC against some other assets, right? If you choose ETH, you should be able to see that here. So this is Ethereum against stablecoins, Euro, ETH BTC. So if you want to sell one to the other between ETH and BTC, just trade that pair. We will stick to BTC USDT. This is the trading information for the currency pair. So the price is this, and this is the change over 24 hours. And then you can just add favorites here as well. Down here, we have the order screen. So any current orders or previous orders, any orders that are live and working, you can see them here. We'll go through charts later. What we want to look at is the order book and the order screen. So for right here, we know the order book now, and this is the price of Bitcoin. So what do we want to do? We want to buy or sell it. So you can see this, buy, sell, choose the one that you want. Spot. Spot is the spot market, the cash market that we're trading in. Margin is where you can borrow money from the exchange and take leverage. Obviously too complex for right now, we'll leave that. So what we're going to do is choose a market order. A market order lets you choose the amount that you want to buy, but it doesn't let you choose the price that you're willing to pay. You're basically saying, I don't care about the price that I pay, I just want to get the order done. So we're going to choose an amount to spend. So we've got Tether, because this is the one that we're spending. And we're going to spend $11 to buy an amount of Bitcoin. And the price that we get, we don't know, whatever the best price is at the time. You can also change to order by quantity. So if you know exactly how much BTC that you want to buy, you can put that in. But you need to know how much USDT that is going to cost, right? And it's not going to be able to work it out because it doesn't know the exact price that it's getting for you. In any case, we'll just stick to order by value, and then we can buy an amount of BTC by pressing buy. Now remember, market order is going to trade immediately at the best price. So if we click the buy BTC button, it's going to check it. That's the order here, buy, right? Then we can go to trade history, and that is our purchase. BTC USDT, we had a buy order. It's filled. You can see we paid a little bit of trading fees there. So we got $10.96, and the filled price is this one. We didn't choose that. It was just what the price was trading at the time. So that's how to trade a market order and literally just buy crypto. That's absolutely fine, but it's like trading your money at the airport, right? You don't know what trade that you're getting. So the more professional way to do this is to use a limit order. A limit order lets us choose the price that we're willing to pay and the amount that we're willing to trade. So we can make our limits. This is the limit of what we want to trade at. So when we put a limit order in, I say 45,000. That's the limit price. That's the max price that I'm willing to pay. That is my limit. And the quantity, we want to trade $15 here. That's the order value. Now it works out $15, 45,000 per BTC. We can trade this fraction of BTC. So we can put the limit order in here. We press buy BTC, checks the order for us, buy BTC. That's down here. Of course, it hasn't traded because our bid at 45,000 is below the market price at 45.99. So we can't trade. Where is our order? Well, it's down here on the order book, lower. The order is working. It's known as a working order because it hasn't traded, but the system, the platform, the exchange is saying, if the market price gets down to 45, and if there's a seller there, we'll trade your order at 45. We've got that instruction. So we're a buyer of Bitcoin, the order value, the price, and how much is filled, which is currently 0, right? So what we can do is actually change that. So we can change it here. So click, and then we want 45,880, something like that. And then we can press OK. Our limit order has now been changed, and that is our limit price. We have a much higher percentage chance of getting this done because we're pretty close to the price at this point. If we change again to something a little bit closer, like 918, we can do that, and we may get filled at this level. If the price comes down, you should see a dot near the price that your limit order is in at. And once it's traded, you will trade there. Now, a tip here is that using limit orders can get you better trades. You can see that the price moves around quite violently. And so using a limit order, by just seeing what the price is, going down the order book by like $5 or $10 or something, and putting your limit order in there a little bit lower, it's just going to save you a tiny bit in each time that you trade. So you don't need to use a limit. The price moves around. If you're just a little bit lower, you might have to wait a little while, but the price might trade and get you a better price. So there's pros and cons to each, because if you put a price in that's too low, you may not change, but a limit order lets you make that decision. If you want to sell your crypto, we can use the exact same order types to sell out for any other currency. So the first thing is we need to know that we're selling a crypto, and we want to know the currency that we want to trade it into. So if you have Bitcoin and you want USDT, you need to trade that pair. If you're looking for Bitcoin and you want to trade it into euros or something, you have to trade that pair. So I'm going to trade USDT here, go to sell. So change it to sell. We're going to use a market order, and we're going to sell an amount of BTC. So you can put that in the amount that you want to sell and press sell. You can also go to a limit order. Now again, because you're selling, you can choose any price that you want. Now, if I said that my limit price was 40,000 to sell an amount of BTC, right? Like $15 worth, I'm going to trade immediately because my limit price is 40,000 and the price in the market is 45,900. This is basically a market order. So it's not, the limit has no relevance because your price is below. But what you can do obviously is place an order above. So if I want to sell this much at 50,000, I can sell BTC. I can confirm this. And of course, that will put a limit order for me. So if the price does get up there, I can sell that. So this is good to use if you want to sell some BTC, you just want to wait or whatever. You need the crypto on the exchange. It's tied up in the order, so you can't use it in any other way. But that limit order is there just waiting to be sold if the price gets there. And just by my head, you can see cancel here. So just cancel out the order if you want to get rid of it. There is also a way to take losses or profits with automatic orders. So if you have an order in and you have an amount that the order is there, so you own some BTC, you can use what's known as trigger orders or conditional orders, otherwise known as TPSL. So you can see that here. If you press conditional, it's actually exactly the same order. What this does is puts in a trigger order for you to do something. So this is usually used with stop losses, which is where you sell your asset at a lower price than it's currently trading because you're selling at a loss to prevent further losses. So if the market's coming down and you're losing money, you can tell the system, I'm happy to lose 10%, but if it gets below that, I actually want to sell out and take a loss at 10% because I don't want to lose 20%. So this is usually used for more active trades. Investors really aren't going to use this because they're going to be just buying and dollar cost averaging over time. But for more active trading, you can set a trigger price. So let's say that I want to sell my Bitcoin, some amount of it. The trigger price is the price at which the order will be triggered into existence. So we're going to put that at 40,000. The order price is the actual order that is put in when this trigger is met. So we can put a market or a limit order in here. So we'll just do a market order, right? So you can't choose a price. What you're saying is when the price gets to 40,000, that's my trigger. Enter a market order to sell an amount of BTC, right? Whatever it is. The reason we can't use a limit order here is because, like I said, if we put a limit order in to sell with a limit of 40,000, it's going to trade immediately because the price is 46,000. What we're saying is sell as long as the price is above 40,000. So it's going to go, yeah, sweet, I can get 46,000, sell. But that's not a stop loss, that's just a sell order. What we're saying is if the price comes down, right, and we are making a loss, that's when we want to sell. So you can't use a limit order. You have to give the system a different instruction, which is a trigger. At 40,000, then sell my Bitcoin, sell BTC. Press that here, and that's going to be a working order for you. That will sell at a lower price than it currently is, and that is used as a stop loss. Like I said, that's for more active traders and people that are trading, shorter term. But it is, something that you can use if you want to. So just a quick bonus tip here for, people that want to gain exposure to crypto and trade crypto. Not really talking about day trading and that kind of tactical thing, which to be honest is extremely difficult And really what we're doing with crypto is looking to take advantage of secular trends and get the best prices during cycles. So a kind of easy way to do this is to look at the Bitcoin price over the long term, know when we're in down cycles in the cycles and the secular trend, and then just really be active during that time. So, what we can do here is go over and say, Bitcoin has these cycles very clearly, up and down, right? And we've seen that. So when we're in a down cycle, which is pretty clear, we're looking at, around a 30 to 40% drawdown is, a down move for BTC. It's pretty harsh. During bear markets, it has typically gone down 70% at the lows, but anything, down 30 or 40% from its high is typically somewhere where investors would get more active. So very simply, we can kind of chart these over time pretty easily, right? So you have these cycles that you can see on the longer term chart. So what you can do then is really be tactical and say, during the time when the price is down in a low cycle, that's when you're more active. And then you can go to, actually trade the asset. So what you do is, put in orders each week or each month. So you can do automatic buys and auto investing on a lot of these platforms where you can say, I put an amount of dollars or whatever on the platform, buy each week at this price. And it's going to do it automatically for you over a time. Or you can simply say, during this part of the cycle, right, I know that I'm going to be active buying. And so each week you just go and, activate your buys there. And then past a certain amount, if you're in a big up cycle and you're nearing all-time highs, maybe you come back from your buys a little bit. So one thing that we can use is the longer term charts. We're using a week chart here. So this is very long term and it's showing kind of trends. And then you go down to trading and you're looking at charts on the 1 day. This is a period which each period is 1 day right now. And so you're looking at shorter term to trade, but then you're looking at trends. Because if you're investing in trends and looking to take advantage, you're really looking at these, right? People get too worried about short-term price movements, but you've got to look at where you are in comparison to where you've been, right? So for Bitcoin, and we know the thing has secular growth, if you're looking at a high, and these are the highs, right? If you're trading underneath that, right, somewhere here, these are areas where investors are active. And it doesn't really get any more complex than that. So if you're a beginner and you're looking, how do I get involved with all this stuff? Maybe just start there and you can get more active, and more professional as you go on. But seeing the longer term cycles and the trends over time, seem to have 4-year cycles of these trends, making sure we are, being active at the bottom of trends seems like a pretty good thing to do. And then you can go over to your crypto exchange. Now we'll come on to a short primer of technical analysis, because when looking at charts, there's some things you need to know. For example, what are candlesticks? What are the time horizons here? How can we make some drawings to make our lives easier? So if you don't know about technical analysis, there's 2 different types of charts, right? We have a line chart that we can look at, right? So we can actually change this to line. So if we change this to line right here, and then we can change this to candles, different information. Lines are great for longer term trends. This is the Bitcoin price. You can see in orange here. So it just gives us longer term trends of what the price is doing. For traders, what we're going to look at is candlesticks. And that's because candlesticks give us way more information than a price chart. Well, you can see the line there. A candlestick gives us 4 pieces of information, which is the opening price during that time frame, the low price during that time frame, the high price during that time frame, and then the closing price during that time frame. Open, close, low, high. That gives us way more information about what happened during that time period. The close is above the open, so we know that that's a green candlestick. Now, in some countries, they don't use the same colors, but in the Western countries, you'll mostly see green for a green up candlestick. Open, high, low, and close. The open is higher than the close. That's a down candle, and we color that in red. plot those over time, you have another type of chart. So we'll go over here. That's the candlestick chart. So these green periods, we know these are uptrends where candles are opening and closing above each other, clearly an uptrend, right? So this is the price of Bitcoin over time, but we also know the price action during that time frame. Gives us a lot more info, and it's a lot more specific with exactly what price at what time. So of course, we have different time frames. This is on Binance here. 1 week, each candlestick is 1 week. 1 day, each candlestick is 1 day. Let's reset the chart. And 4 hour, 1 hour, 15 minute. If you're looking at 15 minutes, 1 hour charts, it's like this. There's no signal there. It's just noise. It looks like the price is moving a lot, but it's moving like 0.5%. If you're investing, you're looking at cycles, which is the real bulk of what we want to trade, right? Day trading is tactical and it's difficult, but these cycles that happen over 4 years, very slow, and we can really take advantage of the meat of these big moves. You're looking at days, weeks in terms of the price chart, really weeks, not even days, it's weeks, right? So clearly what we're seeing here on this chart is we are seeing that we're in a big uptrend here, right? Each of the weeks are seemingly going higher. So we're in an uptrend, we're recovering, price is going up, right? So let's look at candlesticks. This is bearish price action, what we say, because sellers are coming in and forcing the price down. This is bearish price action because we know that this is red. So it opened here and closed here. Sellers forced the price down. This is 3 candlesticks, could be 3 days, 3 hours. Bearish price action. Sellers are forcing the price down. This is bearish price action too, potentially, because what it shows us is even though the candle or the time period finished positive, what happened is buyers pushed the price up to the high, but in that same time frame, sellers pushed it all the way back down to almost make it a red candle. If they did that in this time period, maybe in the next period, that will continue. And so the next period could be a down candlestick. Why that's important is because if you're looking to trade over maybe a day or a week or months or even, on yearly candlesticks, those trends are maybe more predictable in that way. So you can see here that, you have some downtrend, right? You have some candlesticks where sellers are coming in, forcing the price lower. And so sellers seem to be overdoing buyers at this point, right? So it's just the information that gives us that, hey, if you're getting a lot of red candlesticks and they keep falling lower, maybe there's just a lot of sellers around and the price may go lower. And so you can try and predict this or try and say what type of trend we're in, right? You can see here that there were a lot of candlesticks where the price was being moved up. There was some consolidation here, but moving up, right? So that shows us that there's way more buyers than sellers in the market and they're pushing the price up. This is bearish price action. This is bullish price action. Open, close, bullish price action. Keep going higher, bullish price action. This is bullish potentially. Sellers forced it down. Buyers forced it all the way up to almost be a green candlestick. They may carry on in the next candlestick. And so that's how we look at price action. Now we're going to look at support and resistance. Support and resistance are the same thing. It's just a key price level where buyers and sellers seem to meet and the price gets rejected from that level. And so we know who's in charge. So you can see resistance here. It's where the price moves up, but it then gets rejected down, right? And it doesn't go past that level. So that price level is resistance. That shows that there are sellers at that price level and there are too many sellers there that the buyers don't outnumber them. So it turns into a resistance price. This is showing us the fight between buyers and sellers, and buyers are not willing to pay above this price, and that's where the sellers win, and the price gets rejected away from that. Of course, these levels get broken all of the time. When you break through, that resistance level may now turn to support. The reason being that the sellers that were here are now gone. They disappeared because the buyers broke through. So those sellers have gone now. And so the buyers who pushed through and were willing to pay that price now turn that into support. This is literal, it's psychological. You can see it happening in charts. It's amazing how many times it kind of works out. But of course, that is a resistance level that now turns into support. So you get the support where the buyers are coming at this price and the sellers have moved up and are making resistance at a new level. These get broken all of the time, but we can use them as a pointer to where to put our trades and investments and where to be active. So back on the Bitcoin price chart, this is the long-term chart. How do you draw support and resistance? What you need to do is find an area where the price very clearly rejects away from. Major. That is a rejection. Price came up, big rejection down. This is a rejection, big rejection up. This is a rejection, this is a rejection, this is a rejection, this is a rejection as well. You can see that here. This is a rejection, right? So those are support and resistance levels. So what we can do is draw them on the chart. So we'll go up to here. Like I said, tutorials for TradingView and everything, the crypto exchanges, because you can do this on the exchanges as well, all down below, like full in-depth guides. We're going to go to horizontal ray. We're going to draw this on. We're going to keep drawing them. We're going to draw this. We're going to draw this. Right? So now we have some support and resistance levels. You can see that if you drew those before, you see when the price moved up, it got rejected from this level a couple of times. So it gone up, rejection, rejection. It's amazing how that was the same price level as this. So this support turned into resistance. Now we broke through it. So now you'd be looking at new levels. You need to look at this being a support level, trading around here, and then obviously this is going to be a resistance. And this is major resistance because it's the previous all-time high. So that's how to draw it on. Key price levels, rejections, and it just gives you these really important areas where you know the price can get to and reject from. But importantly, if you're a buyer or a seller, you may know where to place your orders now. So let's now looking at using that technical analysis to give us areas where we can trade. So we know Bitcoin has cycles, and we've seen that here, cycle up, down, right? And so what we want to know is we want to be active during down cycles. We don't want to be too active at the top of things, right? So we know that Bitcoin has secular growth in cycles around this. So we can use the secular charts, which is this logarithmic regression, right? You saw that down here in the settings, logarithmic. So we know that we're in a down cycle in this pattern. We know that. So we want to be buyers if we're investing, right? Assuming that we want to invest in the asset, you're going to have to be active at that point, right? And what we know is the trends right here, right? So this data shows that Bitcoin moves in trends where it expands and contracts, expands and contracts, expands and contracts. When you're down here, you're being active as an investor for sure. So what we can do now is go back to a price chart and give ourselves some price levels where we want to be active under. So the first one is a drawdown. We know that this was a key price level under this, 32,000. So what we do is we can go back onto our trading chart and draw this on. That level there, 32,000. Anything under that is a big sell-off because we had support, and eventually broke down. And so as an investor, what you're saying to yourself is anything under here is pretty much automatic buy because you're down at the bottom of a price cycle. You can very clearly see that. These are just regression lines, right? So mid regression, lower and upper. You're down at the bottom end of a price cycle. We know this from the regression analysis and from the technical analysis that this price level, from a price technical analysis standpoint, has broken down through support. Anything under that level is probably a buy if you're an investor and you are looking to accumulate, right? You can obviously just buy all the time, but of course you want to be more active towards the bottom of trends. You don't know where the price is going to go, but these are areas. Then what you can say is, if the price moves up through this, what's the next level that we want to look for? So if you're a short-term trader, a breakout may suggest that you're going to get some bullish price action eventually, which happened. And so that is an area that you want to look at. And of course, if you're investing, what you're saying to yourself is, there may be an area here as well that there may be some resistance, right? So at what point are you thinking there may actually be some resistance here, maybe some, some sell-offs or some choppy trade here? Am I comfortable with this price? Is this price somewhere near the investable range for me? So I just did that as a box on this chart, right? So you can draw these via this. So rectangle, just draw that. Gives you an area rather than a specific line. But what we're saying here is, yes, there is a lot of support and resistance and choppy trade here that it's going to be quite difficult to break through. And that's why you saw some resistance up at this level. Are you happy to buy here? Look at the regression. Are you happy to buy this, right? Or at what point would you be willing not to buy, or maybe buy less, or maybe just come out of the market? With the regression trend, right? So what we're doing here is line, week chart, logarithmic, draw on these regressions via curves. And what you're saying is anything under this line is probably a buy. Anything over this line is okay. But when you get up to the top here, that seems to be a rejection point. Rejection point would be 100K, call it that. So what we can do is go back, look at the price chart right here, and draw on some sort of level, right? 100K be around here. So that could be areas, right? So nobody knows where the price is going to go, what's going to happen in the world. Nobody knows that. All we're trying to give ourselves is some sort of guide as to where we're happy buying or selling. For me, because the price was in a drawdown and we were at the bottom of the trend, anything under this line was like, thank you. Anything above this is fine. But if the trend is suggesting that you meet resistance at these levels, the logarithmic, then anything up here, you have to start questioning, am I okay buying at these levels? If I need the money in a couple of years, short time frame, is it best to be putting it in Bitcoin or crypto when it's at this price level? Because it may meet resistance. And so I need to make that decision. Am I comfortable buying at these levels, or do I not really want to? Do I want to scale back my buys because I think it may meet resistance, and so on? So it's just giving us slightly more professional way of looking at prices and the way that they move, because prices move in cycles and you get expansions and contractions. We don't know exactly where they're going to work out, but this is at least a guide to kind of, in our heads, kind of mentally prepare for what we want to do. There are many more things we could talk about with technical analysis, using metrics and trends to look at. Too much for this video. If you do want to go a little bit deeper, the trading section in the crypto course has all of this. There's hundreds of videos, right? So you can see all the trading videos here about trends and strategies. We've also got some more day trading videos with futures and options. A huge amount of videos here. It's obviously too much for this video. If you want to get a little bit more in depth, obviously those videos are there in the the crypto course. So what we're going to look at now is on-chain analytics and how it helps us make investment decisions. On-chain analytics is something unique to crypto. We can see everything, every trade, every asset flow, when it happens, where the money's going, when and why. It's absolutely amazing, so we can use it to our advantage. There are many ways we can use this to just understand what's happening in crypto, but really from an investment perspective, it shows us how the cycles play out, how people come to the networks and leave the networks, or activity getting higher or lower. And so really we can use this to make investment decisions in that we know that assets are growing over time. That's what we need to know. And the other thing is, when are the price cycles beneficial for us to invest, or maybe a little bit overdone. This is long-term holder supply in profit, and it just shows these cycles of buyers and sellers, right? So when you have the supply in profit moving higher, that's a bull market, bear market, bull market, bear market, bull market, bear market, bull market. It's actually very, it's like a clock, right? It's like clockwork. You can see when these breakdowns happen in the data, that's showing us kind of a capitulation. So you can see where the supply and profit moves down and meets this level known as a bear transition, where it's probably going to keep moving down because you're in a downtrend and a bear market, sell-off and capitulation moves down, and eventually it comes to an area where it starts to reverse. The capitulation has happened. Everyone that wanted to sell or needed to sell has done that. The macro environment is changing. Risk-taking comes back in, and then you get a transition. And of course, you get the bull market transition here, which leads up, right? So you can see these cycles happening. Why it's important for us to be able to see this is because if we can see the cycles happening, we can get on the right side of the cycle. Remember that we know the secular trend is to the upside. So if we want to get the best results, we can take advantage of the cycles. And even if you want to trade short term, you can take advantage of the cycles. But certainly, if we're investors, this is super interesting to us when prices are relatively low, even though you're in this uptrend. So you can see the breakdowns of them and the breakthroughs. Of course, when you're up here, ask yourself some questions. Is this move overdone? Are we at the top of a bull market? What's great about on-chain is that it doesn't really matter what the price is. It just tells us where market participants are. So this is percentage in profit, right? So it doesn't matter what the price is. It's about traders who are in profit and who are in loss, who are capitulating, are new traders coming in, forcing the price up. But it goes in these cycles. So again, this is a piece of information that we can use that, the price has moved here from 15K up to 45K. So some people may look at that and say, I'm not buying at this price. It's 180% up. I'm not buying at this price. But actually, what you're seeing is that you're still not really overdone in terms of typical market cycles. And so it just gives us way more information and takes the emotion out of the price, because Bitcoin's gone up in price for 15 years with huge volatility in between. But if we can know the volatility, understand it, we can actually take advantage of it to make better returns. So that's holder percentage supply and profit. Now, there's so many metrics here that I can't go through all of them. Glassnode is great. Look into Bitcoin is great. I'll leave them linked below. Some of them are free. Some of them have a freemium thing and a paid tier. So you can make those decisions up to you. What we're looking at here is MVRV again. What this tries to do is show us where the price of Bitcoin is in relation to the Bitcoin that's already on the network and has moved before. It shows us how many people are in profit, or is the price in profit and people are kind of moving things around at a higher price. So if we take the Bitcoin price out, what it also shows us is cycles. Up cycle, down, up, down, up, down. No price, but if we could see that during the up periods, where the realized price of Bitcoin being moved is being moved at ever higher prices, that shows a bull market. When we're down here, that shows that Bitcoin is moving at lower prices, and that shows a bear market or a capitulation. If you're an investor that wants to get access to secular growth, the best time to buy is down times. And so without even looking at the price, we know that this part of the cycle where the MVRV is down here is typically a great time to buy. Now, this has happened in real time as well. As we drew down from the last bull market, MVRV came down to the buy zone and has rejected yet again. And that's because this asset has secular growth. If it doesn't, then the MVRV would come down here and then just stay there, right? So obviously that's not great, and you don't want to be trading that or investing in that. We pick assets that have secular growth, and they'll climb out of this to a new level. What we can also do is get the level of trades, right? So we know that MVRV, once it spikes up to about 6, that tends to show that you're kind of late stage bull market and prices are pretty high at that point, and it can't stay there forever, right? It tends to kind of reverse at some point. So you can see it used to spike up to 10, then it got to about 9, 8, and then it's about 7 here. Maybe it spikes up to 6 or 7 here. But as you can see, not the price, not the market price, the level of buyers and sellers, where they are. Still quite low as of making this video. And at the top of a bull market would be up here at 6. Now, if we're at 6, do you want to be putting your life savings into BTC or any of the other cryptos that would have this data? Because each time you've got up there, it tends to be at the kind of top of a speculation bull market and euphoria and everything's great. You know, these things move in cycles, right? Long-term investors just calm down and know that they want to invest through cycles. Definitely when things are bad, that's the best time. And if they want to pay up here, that's fine as well. Because what this doesn't show is price. Remember, we could have bought up here when it was 10 and made loads of money. Because if you put the market cap back, you're buying Bitcoin here at like much lower levels, right? $20. So the MVRV was very high because it was the all-time high at that point. But if you're a long-term investor and you're buying at $20, no problem. So it's not that MVRV tells us what the price is good or bad. It doesn't know what's going to happen in the future. It's just telling us right now, as a price cycle, things are either overextended up or down, and that may reverse. It may continue for 6 months or 12 months. We don't know. It's just a guide, right? So that's MVRV. Then we have the same thing basically, but it's called NUPL, or net unrealized profit and loss. And it just puts the kind of the same thing on a chart with capitulation to greed. So you can see the price again. And if you take the price out, it's just showing us when is the market euphoric in terms of prices are rising. Bitcoin is being moved at rising prices, which means that new buyers are coming in, forcing the price up. When is capitulation happening and that Bitcoin is being moved at lower rates or lower prices? So as you come down, you get capitulation. As it moves up, you get hope, optimism, belief, and euphoria. They just put this on to make it simple, but you can see the cycles here, right? Price cycles of up, down, up, down, up, down, up. And we're going into an up, so we're in belief or optimism right now. Put the price back on, the price cycle flows this. But remember, buying here during euphoria was still a great trade if you have the time to wait, because the asset is just growing over time, higher highs, higher lows in a trend. So the on-chain metrics can really help us with trends and where we are in cycles. And the reason that that is important is because you can overlay that onto price charts and give yourself a lot more information about actually down here when we were in the buy zone, right? That was 15K, the price was 15K. That really is a buy zone, right? So if you're an investor, I mean, when are you buying other than when the price draws down, right? And we're drawing out of here, and now look, the price has done very well recently. But if we go back to the cycle, we're definitely not topping out in terms of MVRV. And so as a long-term investor, do you really care about the price, or just do you care about, as long as things aren't massively overheated, then I'm being active? Again, that's up to the individual, how they want to implement their strategy. Just dollar cost average, don't care about the price, buy for 15 years, or be a bit more active. Everyone can choose what they want to do. If you're truly looking to invest in cryptocurrency as an asset class, whether Bitcoin only or a mix of some of the networks that you think have good growth long term, then price cycles become slightly less relevant, almost irrelevant. You're dollar cost averaging through cycles, and you have a time horizon of 15 plus years, right? You're looking to tuck this stuff away into your retirement account, just looking to gain exposure over time. It's really not more difficult than that. We don't need to spend hours looking at 5-minute charts trying to day trade. That's not good for investing. What we're really looking to do with investing is to be consistent over time, because the way you make great returns is by consistently adding to the size of your portfolio. If you're day trading crypto with $1,000, you make a 5 or 10% trade that day. That's great. The next day, you got to get up and you got to do it again. Maybe you lose money. So you lose money, maybe you win a bit. You're on this hamster wheel going round and round. Now, day trading is fun and great, and we want to make that little extra return. And that's, of course, anyone can do that. That's great. But you need solid assets in your portfolio over the long term that you know are there as a fallback and a base and that chunk of cash that you need for when you stop working. That's what investing is. We don't need to get cute with the market. We don't need to look for the next big thing. We can just look at asset classes. What does this asset class give me on a yearly basis? What is the growth? Huge amount of growth, no problem. Get invested, multiple years, no need to panic. It's going to be around for a long time. So investing is about the long-term allocation of free capital to achieve later benefits, not trading. What asset classes can I utilize to give me the things that I need? You take free cash flow from your income to buy desirable assets that are expected to increase in value over time. You might think that's Bitcoin. You might think it's Ethereum. You might think it's something else. You might think that crypto's got no secular growth and so you invest in something else. It's up to the individual. No investment advice here, but that's investing, choosing specific assets or asset classes that achieve returns commensurate with the amount of risk that you want to take. If you're 80 years old, putting all your money into an altcoin because you think it might do well, probably not a good idea. If you're young and have time to wait for the actual growth to occur, then you can get much better returns by stomaching the volatility and waiting for that secular growth to occur. So we don't have to panic. The money is there. It's there to be made. We just have to expose ourselves to the assets that we want. We're not trying to make money. We're just trying to choose the asset classes that we need. Buying assets that can protect our savings from inflation. So when investing, a lot of people, especially ones that ask me questions over time, they ask me specific questions about the market. Like, what do you think this asset is going to do? What do you think the price will be based on this news event? And the answer is, I have absolutely no idea. I cannot predict things like that. It's unpredictable. There are millions and tens of millions of traders around the world positioned in different ways. Something can happen, a news flow event that can change things. The positioning in the market, it is impossible to know that and to consistently call that right. With investing, all of that is irrelevant, and you only have to say, here are the list of asset classes that produce returns with X volatility, right? So fixed income, where you buy a bond and you get 5% for 5 years. You hold to maturity, that is fixed. Volatility is none, right? After 5 years, you know exactly how much you're going to get back. The returns are lower than something like Bitcoin has been with more volatility. So you can choose exactly the types of assets that you want and blend them in a portfolio to give you the risk that you want to take. It is from you first, not the market. Don't try and call the market. Don't try and call what assets are going to win and lose. It doesn't matter. What are your needs? How old are you? If you're 70, buying altcoins is a bad idea. If you're 25, you can stomach the volatility. Getting exposure to crypto might give you much better returns than buying bonds. How much free cash flow do you have? Right? That's going to deal with things. If you need the cash back, or if you're tight this month, or, you have to choose what is going to be the best thing for you, right? If you don't have much to invest and it's the top of a cycle, is that the best time? Or do you, actually, I don't want to buy at this time. I think, I might need that cash. It comes from you first. What are your future known liabilities? Children, healthcare, education, rainy day fund, insurance, something else, right? You have to know that first. And then what are you saving for? The things I just mentioned, right? If you know that you have a liability in 7 years where the kids are going off to college, you're saving for that thing. Do you really want that in a speculative asset? Do you want to invest in an altcoin where you're like, This money's for the kids' college funds. I can make some money short term. Don't worry about it. Boom, lost everything. Now your kids can't go to the college they want. So you have to think of just what assets are going to do the right thing for actually what you need to spend, because that's what money's for. So if you have a liability in 7 years' time, maybe think about something lower volatility, bonds plus something, right? You can work that out yourself, right? So maybe you take a flyer with BTC because it's at the bottom of a cycle, but the bulk is in a bond that pays out in 7 years because that's when your liability is. So that's going to depend on everyone. It's about you and not the market. Do not call the market. Call yourself, because you know that and you know what you need. Use the assets, utilize them to your advantage. Time horizon, right? And how much volatility can you handle? We don't just have to take flyers on all of this stuff. We actually work out how good an investment is via certain ratios. And it all comes down to risk versus reward, or more accurately, the amount of return that you get given an X amount of volatility, right? Because volatility is the thing that catches people out. They buy Bitcoin during a bull market, the thing falls 70%. They hate it, they lose their money. But of course, maybe they don't know about the volatility of Bitcoin before getting into it, and they don't know about cycles and the trends. So as long as we know that and what returns that we get for a commensurate amount of risk, we can just create any portfolio that we want. Does high risk actually get you those high rewards? The way that we can do that is Sharpe ratio and Sortino ratio. This gives an outline of the risk-adjusted return of an asset or an index or whatever you're buying. Performance of X in relation to the market portfolio. Sharpe ratio measures risk-adjusted return. You also have the Sortino, which is a variation of Sharpe that gives negative deviation as well, right, as positive volatility is desirable. So what you're looking at is, are you making returns based on the drawdowns as well, right? So what is the risk-adjusted return of the thing? So we can see that. This is a measure that you can very easily look at. This is Sortino ratio for large asset classes. So as of making this video, you can see for each of these cycles, the 2013 to 22, 2017 to 22, and then 2020 to 2023. You're seeing Bitcoin essentially, for a Sortino ratio standpoint, the best risk-adjusted asset. So despite the massive volatility within Bitcoin, it is paying you much more for that amount of volatility than other assets. Now, of course, gold and S&P, NASDAQ, great, big indexes. The S&P and the NASDAQ are the kind of basis for a portfolio. And they give you less volatility than BTC, but they pay you even less in returns. So Bitcoin has more volatility, let's say X plus 1, but it gives X plus 1.55 in returns. So it's paying you more for volatility than everything else. This may change. It changes all the time because the price changes. So during bull markets, this is lower. During bear markets, it's lower. During bull markets, it might get higher. This is a fact. I don't know if this is going to continue, right? It may not. Bitcoin tomorrow may, blow up as a network. No one knows what's going to happen in the future. But this is a historical fact. Bitcoin is the best producing asset from a risk-adjusted return standpoint. This is Sharpe ratio, which is a similar thing. You can see the cycles here, right? So as Bitcoin moves up into bull markets, the Sharpe ratio gets really high and amazing, and the Sharpe ratio draws down during bear markets. But overall, what you really want to be looking at is this, right? So you can see that the Sortino ratio of Bitcoin over time is, of course, very, very desirable. This is Sharpe ratio as well. So we're looking at Bitcoin versus ETH, gold, US stocks, real estate, bonds, emerging currencies, the asset classes. You got to choose one of those to invest in. If you're investing for your retirement, these are the asset classes. As you can see, Bitcoin is also, for most of the time, the best risk-adjusted asset in the world. Has been for a very long time. That's why it's potentially desirable for a lot of people. It may not be in the future. I have no idea. But This is just pure factual data. Given that these ratios are telling us that any amount of invested money in Bitcoin will outperform other assets, what we can also look at is how a portfolio of buying this asset over the long term should give us higher returns. So on Look Into Bitcoin, we've got a dollar cost average strategy, which is buying an amount, $50 each week, and you start 5 years ago. Given that Bitcoin is supposed to have a higher Sharpe and Sortino ratio than others, it should actually outperform them. So you can see that here, that the percentage change, just by my head here, 200+%. You've got gold here, Apple stock, and the Dow Jones. And so you can see that it has, despite volatility and big drawdowns, outperformed those assets. So it's not about volatility, it's not about risk, it's about risk-adjusted reward. Can you stomach volatility? Is that thing paying you extra? If that thing just simply has more growth than other assets, it's going to outperform them. But of course, it can be very volatile. If we have the time and the stomach for that, we can get the outperformance. We don't even have to call the price. All we have to do is wait. We have to identify what the asset classes are, what the yields are that we get from them over time, and then allocate to them. And if you want to outperform, you can just choose those assets as long as you have the time and the stomach to actually get into them, have the drawdowns and everything like that. Here are the top asset classes that people invest in. And so if you're looking to build up a portfolio, save money for the future, which is really what we're doing here, crypto is great. We love crypto, but if it's not giving us the returns, then it's not investable, right? At the end of the day, supporting a crypto like a football team or anything like that is obviously it's an embarrassment, right? What you're looking to do is take advantage of assets that provide value for you. Save your money over time, make returns. Doesn't matter what it is. As long as they do that, we can put them in a portfolio and anyone can choose the amount of risk that they take. These are the top assets that are investable asset classes. I think Bitcoin is, many people don't. But Bitcoin at the top, you can see the annualized return outperforms everything else. You get these massive, massive drawdowns of 70, 60%. Yet the annualized return is almost 10 times all of the other asset classes. It's much newer and therefore you get the volatility. Of course, we can put any portfolio together we want, right? So how much risk do you want to take? You can put together a portfolio of, well, NASDAQ technology is doing really well. US growth is doing really well. US large caps, right? So it seems to me like US large caps will be the S&P 500. So US tech and businesses tend to outperform. They do really well. You're getting around 10 to 15% a year returns for that. That's going to protect you from currency debasement, which is why those indexes are great. Now, Bitcoin, with so much outperformance and volatility, maybe people would want to add a certain percentage to their portfolio. So a lot of people hate Bitcoin, hate crypto. Jamie Dimon says it's garbage, it's worthless and everything. What type of circus clown says that the best performing asset over 15 years, 10x anything else, shouldn't be in a portfolio, right? If you're an asset manager, either a professional one or doing it yourself, your job is to put together a portfolio that gives you a good amount of return. This one is without a doubt the best performing asset. If you are not including that in your portfolio, you are a clown. That is a fact. That's not an opinion. This is factual stuff. This isn't a one-year thing. It's not a joke, right? At what point after 15 years do you have to just admit that this thing doesn't seem to be disappearing? Now, you may say, not too sure, pretty risky, I don't understand it yet. That's fine. So you can make a portfolio of 1% allocation to the best performing asset in the world. Maybe 2 or 3, maybe 0.5%. You can take that. But to ignore asset classes that are growing is obviously idiotic. However, these assets just are used to give you something that you want. So you can see REITs. This is property, about 7-8%, good return, right? You can see bonds down here below my head. They're pretty much like 2, 3, 4% garbage, right? But if you're 70 years old and you know that you need, 15, 20 years or whatever it is, then maybe that's all you need because you've got your savings. You can actually switch from the volatility into the less volatile stuff. That's what you need. It's not about calling the market or being right or anything. It's just about allocating the amount of risk that you want to asset classes that grow a certain amount each year. So over this very, very long time, these are the averaged annualized amounts. So what you can do is just, pause the video or screenshot this just to see these. These are what's going to happen. And so you can take as much or as little risk as you want in these things. Now, remember that the inflation rate or the currency debasement rate is around 7%. Seeing that inflation, currency debasement, we know that the cost of capital is around 7% a year. So anything that's under that, you're actually losing money to the rise in prices of goods and services. Anything around that, you're saving your money. Anything more than that, you're actually growing at or above the cost of capital. Everyone can make their own decisions, but asset classes need to give you a return, and as they're volatile, it's fine, but obviously they need to give you that return as well. If you are investing over longer time periods, you don't need to call the market. You don't need to call prices. You don't need to be correct in any way. You just need to make a decision about what assets that you want to get exposure to and let the price gains play out. Assets will outperform dollars. You will make returns. You don't need to do anything other than choose where you want to allocate, get your percentages, and then just wait. The big thing as well is that it's not about trading with small amounts. It's about making the biggest portfolio that you can and having something reliable. If you save up for 30 years and you get a portfolio of $1 million, a 10% move per year, that's 100 grand in your bank account each year on that $1 million portfolio for doing nothing. You haven't even woken up and you're getting those returns. And that can pay for the rest of your life, right? If you're trying to trade short term with smaller amounts, you're trying to be tactical, you're just kind of one day away from losing, right? And it's not reliable. So time in the market is really the thing, and being able to invest confidently in the assets. We've all seen those assets that go up, altcoins, right? You get 10x in the altcoin, and we want it quick. We want it quick this cycle. I get that, I totally understand that. And we can have our bag for that, our risk bag, right, in the percentage. But the bulk has to be large, reliable assets that you can put big money in. Because if you can have a bigger portfolio, smaller percentage gains that are more reliable, that's the sweet spot. How many people approach the market as a dollar cost averaging strategy? Dollar cost averaging simply means buying with the same amount at set intervals. The reason why most of us do this is because we earn wages. Some of the wages goes into our retirement account. Some of the wages goes into whatever we want. So that's how it's done. So every month you get paid, some of it goes into your savings or whatever. After an amount of time, like if you plan on being alive for the next 20 years, why not have a plan for that? And suddenly 20 years goes by, you've got a big portfolio and you're in a really good position. But if you're constantly speculating, trying to trade, it's more difficult. So dollar cost averaging, put money in over time, and then you just get an average price of whatever this is. Remember, you're exposing yourself to assets with growth, and that's what's going to get the performance for you, not timing too much. DCA, or dollar cost average, buying every week the same amount. It's not a better strategy than the other thing, which is lump sum. Lump sum, you got 50K, put it all in. Neither is good or bad because you don't know where the price is going to be. So you could dollar cost average and actually get a worse price, especially on assets that are growing like Bitcoin. If you're buying and dollar cost averaging as the price moves up, you're getting worse prices all the time. If you could put all of that money earlier, that would have been better. Most people that don't have this choice, we earn wages, we put a bit away, dollar cost average, and so buying amounts each week. It's access to the assets with growth that give us the performance. I cannot give investment advice, and each person is going to have to think about what percentage can they do with their income. This is just a guide. So you have income and you have your expenditure, or you have assets and you have your liabilities, right? So we have an income each month, and let's see where are our liabilities, where's our spending, and then what can we put towards assets, right? So money doesn't exist, you only have assets and liabilities. You've exchanged your labor for this money that's just numbers. Now we have to allocate those numbers in the way that benefits us. So you get your income, whatever that may be. You pay rent, so that's just out. You pay a mortgage, 5% that you're paying on your mortgage. Maybe your mortgage is 5%, 30-year or something like that. A mortgage is basically forced savings in property. You're investing in real estate, right? A mortgage is, I want to buy this house, I can't afford the whole thing, so I'll pay for it over 30 years. It's like a savings plan for property. And so if you're living somewhere and you think you're going to live somewhere for a period in time, certainly a mortgage or investing and saving in that property may be a good idea. We know that REITs or real estate investment trusts, these are basically broad investments in property. They go up around 7%. So they go up in line with currency debasement. So as long as you are paying for the property with an interest rate that is lower than the rate of currency debasement, you're all good. If you're paying more in interest than the currency debasement, it's not a great leverage play there. But if you live somewhere, maybe mortgage is good to save in time. You're dollar cost averaging into real estate. That's what you're doing. You have car payments, right? So that has to be paid. 4% you're paying for the car payments. Student loans, you're paying an amount there. Used to be free in the UK, but not anymore. That's where I got this from. The amount that students are being paid now. Credit card, you got some money on there, you're paying 20%, right? So not great. Then you have insurance that you're paying each month, and then your other monthly costs, food and entertainment or whatever. After all of that, you have excess capital that you can put into investments. Of that capital, you have a pie chart, or whatever, a percentage in each, right? Whatever you want to do. Everyone's different. You need some cash on hand for a rainy day fund. If you get injured or lose your job or whatever, you need some money there, right? As a backup. You need that safety, right? Then you need maybe 6 to 12 months of spending cash for rainy day. Now, again, that could be 2 months, 3 months, 8 months, up to the individual. If you have an amount of cash that is your rainy day fund, and you know it's there for drawing in payments or whatever, you would probably put that in a money market fund. So a money market fund is a short-term investment that the money market fund, these are run by the big firms like Vanguard or VanEck or whatever. They invest in government debt, short-dated government debt, right? And so you're going to get paid back. It's a small yield, right? Maybe 2-3% or something like that. The money market fund, you can trade them easily. So buy them, sell them. You might have a savings account that basically does it for you, whatever it is. Money market fund for that cash that you need. Because if you don't need it immediately, if it's not like your day-to-day cash on hand, then you should be earning some yield on it. Because otherwise it's just getting debased. And the money market funds are very liquid, fungible investments. You buy and sell, but you're getting the yield. There are other ways to do that. For example, with crypto, you can use stable coins, and then you can use DeFi, and you can lend out on DeFi and get yield like that. So some people do that for their money market fund if they choose. Whichever one is easiest for you, maybe cash in the bank's better. Then you have your home equity, which is your assets, and that is being gained each month. So if you're paying this off, each month you're paying some of the house back, you're getting equity in your house. That becomes an asset now that you can draw on. So if you've paid 2-3 years, you have equity in your house now, and that's actually something that you can use. You can leverage it, right? You can change that around. So that's actually an asset that comes into you every month. Then from here, this is your risk asset portfolio, right? So again, everyone can choose the amount that they want, but we've seen all of the performance of, what's happening here. So again, these are risk assets that you can choose, but you can make any percentage portfolio that you want, right? So have a pie and say S&P 500, that's, we know that's strong and reliable as an index. NASDAQ outperforms a little bit, but it's a bit more volatile because it's technology. Bitcoin's super volatile, but it's a great risk-adjusted investment. And then I've got my altcoins here and some other bets that I just want to use, and I think they're great networks. Then you've got mid-caps here, right? Like mid-cap companies, you buy an index for that as well. Whatever it is, it's like 50, right? 25 for this, split this up, whatever you want to do. And as long as you're comfortable with the risk and the volatility of those, so you know what they draw down, you know the return that you should be getting each year, and that's up to the individual to choose, but it's as simple as that. All of the emotion, market timing, market expectations taken out of it. Simple, straightforward way of trying to save the value of your output over time. To end this section as well, I want to quickly touch on CAGR, or compound annual growth rate. This is the annual growth rate of the assets that you're investing in. So we saw this, which is annualized figures. So that can be, what is expected to grow. Now, what this is going to do is, index these early amounts where Bitcoin was growing thousands of % in a year or so. And that's just not going to happen, right? So what we usually do is a 4-year CAGR, or you can do anything you want, but 4-year CAGR. So that means over the last 4 years, with volatility in between, what was the growth rate around about? Well, Bitcoin's CAGR, as of right now, so this is black Bitcoin price, orange compound annual growth rate, is 60%, 55%. So that's the compound annual growth. You'll see as the price goes up, the compound annual growth goes up. As the price goes down, the CAGR goes down. You can see that also over time as Bitcoin matures, its annual growth as an average of 4 years tends to decrease. It's around 55% now. But let's take Bitcoin if it was a 20% annual growth rate. So you know that if you could hold the thing for like 5 years or, an amount of time, it's going to give you maybe 20% a year. Then you can start making decisions about the other liabilities that you have. For example, if you've got a 6% student loan, should you use your money to pay off the loan at 6.25%? Or should you keep the loan, pay the interest, whatever, and put the money in Bitcoin? Bitcoin is growing at 20% CAGR. And so you could do the calculation there that actually it's better to keep the loan because the money that you've got to pay it off in an asset that's growing faster than the rate of the loan is actually going to pay off the loan at a faster rate than you paying off the student loan, because the interest is 6 versus 20% CAGR for BTC. If you've got these are also low, but if you've got a credit card, maybe that you should pay that off first, right? So it's about risk here. Bitcoin could have a 20% CAGR. It could also go to 0 tomorrow. The network could blow up. If you pay off your credit card, you're paying off that loan and you're saving 20% on the balance of that loan each year, and you have 100% certainty that that will happen. So if you've got high interest liabilities, maybe make a decision, do you want to pay them off? You have 100% chance of getting a better outcome by paying that off. This may seem good, but there's volatility. There's no volatility. So that's why I always come back to it's about you and your circumstances and what makes you feel okay. Because having debt is a burden, and maybe Bitcoin can outperform that, but maybe that's not where you want to be as an individual because it stresses you out and stuff. So it's about the individual, who you are, what you want to decide, and what's best for you. Now we'll look at using crypto wallets and some of the security implications of buying crypto. Because if you buy crypto, you'll either do so on an exchange, and so you're giving the exchange custody of your assets, or you withdraw them into self-custody. Now, there are Bitcoin ETFs, as of making this video, which means that you can just buy the ETF, which is an exchange traded fund, where basically, well, the way it works right now is that Coinbase is the custodian. So Coinbase custodies all of the assets for the ETF providers. The ETF providers have the assets. The exchange traded fund is something that you buy in your stock brokerage account. You just have the ETF. You get price exposure to Bitcoin, but you don't own Bitcoin. You can't use it. You can't do anything with it. You just get price exposure. That's obviously custodied for you, but you have trustworthy institutions doing this. So if you want to take self-custody of your assets and actually use them, how do we do that? Because you can get price exposure through an ETF, but you can't use it, right? You can't send it to someone. So it's different. So wallets are, of course, the thing that we use with blockchains to take self-custody. Wallets let us access crypto accounts. Crypto is cloud-based money, and so the money is always on the blockchain. It never goes into your wallet. It is not a data packet or a thing that goes into your wallet or your application or anything. It's all on the blockchain. You just have access to an account. So that's what the wallet is. It's basically an account that sees the assets that you have in that account in the cloud, which is the blockchain. You never own or hold any crypto ever. No crypto is in your wallet. No code representing crypto is on your device. Wallets, what they do is they hold keys to spend the crypto associated with the account. So you open an account and you get keys. It's like a password. Anyone who has that password can spend the crypto in that account. If you know the keys to a wallet, the wallet is yours. Anyone who knows the keys has access to that wallet and can spend them. Crypto is therefore a bearer asset. If you have keys to a wallet, you own it. If you have someone else's keys to their wallet, you own their money because it's a bearer asset. You have their keys. You can open a wallet account, open a wallet app, put in the keys, have access to their crypto. It's like an email account, right? So you have a wallet address that is the email address, and you have the keys, which is the password to spend the money. A wallet is not an app that you use. The apps that we use, like Trust Wallet or the other wallets out there, these are interfaces. These just let us access the wallet, which we created on the chain, and they give us an interface that we can use. This is how you set up a wallet. You go to a wallet provider. Now, I've got videos on best wallets and things like that, which I'll link below as well. Some links to the wallets that I use as well, I'll link down below. But you go to a wallet provider and you open a wallet. That wallet provider will help you open a wallet on that blockchain. You then get an account. That's step 2. In step 2, the wallet application that you're using helps you open an account. You get a public key, which is your email address. You can't choose this, it's just given to you. So that's your email address where people can send you crypto. You also, within that application, get the private key. That's like the password to your email account. The application that you use keeps that private key in the app. And of course, that's the thing you need to spend crypto out of the app. So the third thing that you get that you actually see is a seed phrase. Seed phrase is linked to the private key. The seed phrase is a human readable list of words, around 12 to 24 words. The private key is like gobbledygook, right? It's like this. And so you don't want to write that down. So the way that we write it down and have a kind of offline way to recover the wallet is the seed phrase. This is what the seed phrase looks like. It's literally 12 human readable words. You write them down in order, and that is your wallet. So what happens is when you get the application, what happens if you lose your phone? Well, you don't lose your money because your money's in the cloud. It's on the blockchain. Well, how do you recover that wallet? You recover it with the seed phrase. So you write the 12 words down on a piece of paper. Then you download the application again on a different device and it says, do you want to recover your wallet? You say yes. It says, what are your 12 words? You write these 12 words in and it says, you own this wallet because you have those words. And it brings up all of the balances you had in your wallet. So this is like a master key. The issue with this is that we're in the digital age, we're using cryptocurrencies and money in the cloud, and we're writing down 12 words on a bit of paper, which is obviously ridiculous. There are other ways to do this. You can buy steel seed phrase cards, which are a card or like a tube where you can have steel and you kind of put the words in steel and you close it up and stuff. Still ridiculous. This should be digital. So there's actually two things that we need to worry about with wallets. Where is the private key stored? And how is the seed phrase stored? They're the two things we need to worry about when we're choosing a wallet. So these are the different types of wallets that we can use. Software wallets, hardware wallets, and MPC wallets. There are others as well. There are paper wallets where you write down the private key on a piece of paper. So they've really been phased out because they're obviously awful in terms of the use case. But these are what most people use now. So all of these wallets, what they're trying to do is, where do you store the private key and what is the seed phrase backup? They're two things that are different amongst all wallets. Software wallets, otherwise known as hot wallets, these are an application that you download. These are completely free. Trust Wallet is great on your smartphone, MetaMask, many others. I'll leave links below to the tutorial videos on exactly how to set them up and use them and what they're like. Free to use, phone, browser, you get a wallet and then you can receive crypto. The downside is that the private key is kept on the device. So it's on your phone or it's on your browser. Could get hacked. You could get a keylogger. It's not very safe because it's online. So if a virus comes in, it can take your private key. And remember, if something has your private key, it owns your money. That's where hardware wallets come in. Hardware wallets are special physical devices like a USB stick or a smartphone thing, whatever. And what they do is they create your private key on that device only. And it's not on your computer or on your phone. It keeps the private key on that device. These cost money and they're annoying to use because it's a hardware thing. So if you want to spend coins from your wallet, you need the hardware device with you. You need to then plug it into your computer to spend coins if you want to send them somewhere. It's a little bit worse, but it's a lot safer because the private key is offline all of the time unless you want to spend the coins. You also have to physically accept spending coins on the device, and the device can be set up behind a PIN number or a fingerprint scanner. So the private key is much safer because it's offline. So that's great. The downside here with hardware wallets is that the seed phrase is also something that you have to write down offline. So this one here, the seed phrase, you have to write down on a piece of paper, but the private key is online. This one, the private key is offline, but you have to write the seed phrase on a piece of paper. So you're in the digital age, you've got a hardware wallet and a piece of paper, and if you lose that piece of paper, all your money's gone. Because if you lose that hardware device or you can't access it or it breaks and you don't have your seed phrase back up, no one can recover the wallet for you. Not great. The next option is MPC, which is known as multi-party computation. This attempts to split up the private key and the seed phrase amongst different parties and encrypt it. It's all digital. So what happens here is that these are applications that you download. So for right now, as of making this video, Binance and OKX have Web3 wallets with MPC, but there are other separate providers as well. And so what you do is you set up an account with the MPC provider. You give them some sort of login, like an email address. So they need an account to associate with you. The private key gets split up into 3 shares. The wallet provider has one. You hold one in your iCloud account. And the other is 2 of these, usually 1 and 2. And this is on your phone. So your phone can spend the crypto out of the wallet because it has 1 and 2. So you log in with the wallet. It knows who you are because you have that login with your email address through 1. And on 2, you have the second bit of the private key. Of course, you need 2/3 of the key to control the wallet. The wallet provider doesn't ever have 2/3, they only have 1/3, and so they have no control over the wallet. The private key is also encrypted and sharded, meaning that they don't even know what it is. They just know that it's associated with your account. They also know through cryptography that this second share is linked to it. And so when you put 1 and 2 together, it lets you spend the coins from the wallet. The third is in your iCloud or your Google Cloud and also encrypted and hashed. This is for recovery, so that if you lose your device, you can go back and get your cloud account open on a different device, download this. 1 and 3 together makes 2/3, which can get the wallet back on your device in a fresh number 2. You never expose your crypto to 1 because everything is hashed. And so it just knows that 3 and 1 are linked in some way, but you're not exposing the key. Also important is that your private key actually never gets exposed. It is encrypted and hashed. And so even when you're spending coins, you're not exposing your private key, which means you're not technically keeping your private key on your device. This is a digital way to try and get around the private key and the seed phrase problem. So with MPC, all you need is to remember is your iCloud account login, because you need to be logged into that. And then you set up a password with this or a PIN number. So that's all you need to remember. You don't need to remember 12 words. You don't need to write it down if you don't want. You just need to remember that password that you set up. This is trying to make seed phrases and private keys a little bit safer. It's coming into more and more use in the crypto industry, but these may be useful for you as well because these are self-sovereign without any accounts. And certainly for this one, for the hardware wallet, there's no digital signature if you don't want there to be. Here's an infographic of the pros and cons of these hardware wallets. So I'll just get out the way so that you can see this. MPC really is more or less great for every option. Software wallets, you can really just use MPC at this point if you want. Hardware still have an advantage of no digital signature or no digital account. They do cost a little bit of money. Here is hot cold versus MPC. Again, you can read this. I don't want to go through this, but you can just see this and screenshot this in terms of pros and cons. And then what I want to talk about is, do you need to use a wallet? Is it best for you? Or should you just let someone else deal with it? Self-custody is self-sovereignty. You have ownership of the asset. That's the entire point of crypto. The reason why Bitcoin was invented is when all the banks went bankrupt and everyone was bailed into the banks, meaning you can't take your money out. Sorry, your money isn't yours. With crypto, it is yours if you take self-custody with it. They can't do that. But if it's custodied somewhere, you're at risk. You have to balance that risk if it's big or not. Now, banks are different to asset custodians. Banks do not keep your money. They leverage out your money, they lend it out. They do not have your money there. That balance in your bank account, not there. Banks are levered 9-to-1. Your money is not there. If everyone wanted to draw their money out of the bank at once, the thing is literally bankrupt. It's insolvent. Asset providers are different. Asset providers like Coinbase and Binance and ETF providers, these are not banks. They hold assets one-for-one for clients. So it's very different than a bank. Asset providers are not banks. They should be holding one-for-one. FTX didn't, but the other crypto exchanges have proof of reserves that show one-for-one backing. Asset providers are not banks. They're different. So different risks, but there are still risks. With self-custody, everything is on you. You are responsible for keeping that seed phrase and private key safe, and you have to have that in your mind, and you have to keep up with it to make sure that you're not going to get hacked or lose anything. If you have self-custody, do your family know about that? In an inheritance scenario, can they access that crypto? Or is your seed phrase buried in the garden and they don't know it's there? And you've got $10 million on there, and that's their inheritance, and you're gone, and they're broke, and they can't get your money. So that is something to be aware of as well, that you have to think about. Also, self-custody can be expensive because if you're buying Bitcoin, fees on the Bitcoin network are going higher as the network grows. You may have to pay $5, $7, $10 for a transaction during heavy times. If you're saving smaller amounts, $500 or something, that's a lot, right, to send out and back in. Plus, Bitcoin has UTXO problem, which is if you have many small UTXOs, each time that you spend the coins, you have to spend each of those UTXOs, which can add up if you're putting small amounts in. Essentially, it can become costly when you want to send out the assets. ETH is expensive to use. So if you've got $500 and we're drawing it to ETH and you're paying $15 for a fee for a blockchain, that's impossible, right? That's going to eat away so much at your investments that you shouldn't be using it at that point. So it can be really expensive, especially with smaller amounts, because these are just flat fees that you pay to the blockchain. That's where custody comes in. Now, if you're using Coinbase or BlackRock, these are professionals. They're not going to lose your crypto. And if they did, they're probably going to have to pay you insurance or just make it up themselves. So they're professionals using the highest quality, custodial solutions, right? Custody is mostly free. Like Coinbase, if you put money on Coinbase, free. You don't pay anything. Binance, free. For the ETFs, they may charge you 30 basis points a year as a fee to have, the custody there. Not the end of the world, right? If you're paying for custody and you haven't got that worry. They can be custodied specifically for the ETFs. For Bitcoin, and I'm sure others are coming, they can be put inside a tax wrapper, which you might not be able to do with the currency directly, especially if you're holding self-custody. All you need is a login and password for your Coinbase account or something, or your ETF brokerage account. It's right there. Inheritance isn't a problem because you can just say, hey, look, I've got a Vanguard account. They can recover it, no problem. Or, Fidelity. Fidelity are the good guys, really into crypto. So if you have an account with them, they're supportive of crypto. And the problem with custody, which we found out with FTX and others, is that if you have crypto on an exchange, you are actually an unsecured creditor of that exchange, which means that you are last in line to get your money out. And if the exchange has gone bust, you're not going to get much back. That's custody, so that's an issue. Now, proper professional asset managers, BNY Mellon, right, people like that, BlackRock, they're not going to be doing any of that stuff. They're going to be holding your assets in trust, separated from their business, and you should be able to get one for one back. But it's an issue, especially if you're using crypto exchanges where they're small or whatever. The thing is with custody is there's a lot of advantages. It's easy, it's cheap, but there are downsides as well. So self-custody or custody, there's no right answer. It's going to depend on you and where you see the balance of risk. One of the main innovations, though, of cryptocurrency is peer-to-peer value transfer. So we're not just buying these internet coins and hoping they go up in value. You can get things done on these blockchain networks, right? We can lend, we can borrow, we can trade, buy and sell. And we don't have to use a centralized intermediary. What's the difference between CeFi and DeFi? Not much. DeFi are protocols. So it's a protocol and it's on the blockchain, and there is code there that dictates the rules. We use it at our own risk, right? With centralized, they're doing all of that in the background, but they're just giving you a nice wrapper on top. You have to trust them that they're not going to steal your money or go insolvent. You don't have to do that with DeFi, but there still are major risks. DeFi protocols can have a bad debt, things can go wrong, hacks, scams. If you send money to the wrong wallet, your fault. If you click on a phishing link, your fault. No one's going to help you. There's many downsides of using blockchains directly, but we can get things done on them as well. And these protocols, have opportunities. The only real difference between them is that on DeFi, there's no KYC, know your customer information. With CeFi, you need to give your driving license and everything like that. With crypto, we can just use things and we're just sending code around. This is how a blockchain works. You have a wallet with your money in it. You send the coin to another wallet. A small amount goes out in the blockchain fee. You have to pay a fee to the people. When you use a protocol like a dApp, decentralized app, lending, borrowing, trading, you send your money, you interact with the smart contract. which costs a fee. You pay a blockchain fee for that. You pay a fee to the exchange or something like that as well. So you may pay 3% as a trading fee or anything else. Or if you're lending money out, they may take 10% of your profits, something like that. You also pay a blockchain fee for every transaction. And then eventually it actually goes back into your same wallet, right? But you've paid those fees out. So dApps applications are businesses just like centralized exchanges, right? The only difference is they're on the blockchain in their code, and there's no one there making centralized kind of decisions about what's happening, right? You can do it any time of day, but these are not decentralized, right? There is a group of people writing the code and, making the application, upgrading the application and things like that. So it's not really decentralized, but it is permissionless, as in you can permissionlessly access it, and any time of day, you don't need KYC. That's pretty much the difference. So what we're going to do is use some applications to show you. So for right here, I have a blockchain that I want to use. I know that I want to use BNB chain. It's low cost, just for this example. So what do I need? If I'm going to use a blockchain, first thing I need is gas to pay for fees. BNB chain uses BNB coin as fees. So I'm going to go to Binance and buy BNB. Now what I need to do is send that out to a wallet. Many wallets you can use. You just need to make sure that the wallet accepts the coin and the blockchain that you want to use. So I'm going to show you MetaMask as an example. MetaMask is the wallet that a lot of people use for Ethereum DeFi. So all of the EVM chains, Ethereum, BNB chain, Avalanche, Polygon, Optimism, Arbitrum. In fact, you can see all of these here. These are the list of all the chains. These are EVM chains, so they all use kind of the same code. And you can add them all in your wallet. These are different chains, so you have to make sure that you're using the chain that you want. I'm not going to go through setting up MetaMask here. I've got wallets videos below on recommended wallets, how to set them up, how to use them. So you can get into the details there. But we've got a wallet set up. And from here, this is a browser wallet. I know that it supports the chain that I want to use. So what I'm going to do is go onto the chain. This is the chain that I want to use. This is my address right here. So this is my wallet address that we need to give Binance because we're sending BNB out from them. So I'm going to copy this, go back to Binance. I've bought some BNB. I'm going to paste my address in here. This is my wallet address that we know that we want to receive the coins to. The network that I'm going to use, I know that I'm using BNB Smart Chain as a network. Because I'm receiving on that network, we need to send from that network. So the centralized exchange supports all the networks. And as long as the exchange is supported, they'll have some value there that they can send out to your wallet address. So as you can see here, this wallet address is actually supported on 2 different networks. These are both BNB networks. Which one do I want to choose? I know that I want to receive it on the BNB Smart Chain. So I send it from the BNB Smart Chain from my exchange. Yes, I'm sure that I can accept that. Now, the exchange knows the coin that I want to withdraw, the network that I want to receive it on, and the address of my wallet. That is the same for every network. Then I can choose an amount that I want to send out. So I'm going to withdraw whatever amount of BNB. I press withdraw. Just check the details so that you have the wallet address and the network that you're using. You can't receive on different networks. So if you're sending from Ethereum and you expect it on BNB, it's not going to show up. What you can do is go back to your wallet. And if you've used this address, this is an EVM address, which means it's the same address across all EVM networks, which are these ones here. If you sent from your Binance and you withdraw on Ethereum, it's going to be in your Ethereum account on the Ethereum blockchain. It's not going to be on the BNB Smart Chain. So what you're going to have to do is, well, firstly, you've sent the wrong coin. And secondly, you don't have ETH in your wallet because you need ETH for gas on the Ethereum network. So it's really important that you get the coin and the network that you want. I know BNB Smart Chain. So what I'm going to do is just withdraw this and it will take 5 minutes. It will just send that out to my wallet. Actually, it will take more like 25 seconds. BNB Smart Chain is quite a fast chain. So you've now got a balance in your wallet of the gas coin. you always need the gas coin, and you need an amount in there to do anything to pay for gas. You can, of course, withdraw different assets from your Binance account. If you're looking to withdraw an asset built on top of the chain, like a stable coin, you can withdraw that to the same address. But in order to use that, you need gas. So you need the layer 1 coin at all times in your wallet. So we've got this amount here. So what can you do with money? You can trade it. So we'll do that. This is a decentralized exchange. PancakeSwap is decent. It's been around for a while. A lot of people use it. I'll link a video guide as well below if you want to use. The thing with DeFi is that anyone can create anything. So make sure you're going to the right URL for all of the DeFi apps that you use. I would star them or favorite them to make sure that you're going to the correct URL, because there can be fake ones. Connect your wallet to it, all your money's gone. Make sure you're going to the right place. I would double check as well on Twitter, on the Twitter account, the official Twitter account of each protocol, the URL that you're going to. From here, we need to connect our wallet. So I've got a wallet in my browser. I'm going to press connect wallet. I know I'm using MetaMask, so I'm going to click this. By the way, Rabby is a great wallet as well. Yeah, highly recommend it. It's great. But we'll choose MetaMask for this example. My MetaMask is now connected. You can see that. So my MetaMask is connected to this wallet. We want to make sure that we're on the right chain. You can see many chains are supported here. So I'm using BNB chain. If we go to Ethereum, it's going to switch to this network in my wallet. So switch, come out. Now you're on the Ethereum network. These are different. Different networks have different pools of liquidity, different amounts, different coins are traded. These are like banks, right? So one bank is separate to another. So one blockchain is separate. The fees are going to be different, more or less, and what's on offer is going to be different. So for me, we'll just switch back to BNB. And so I've got my wallet connected and I'm on the BNB chain, which is what I want to use. We're going to trade an asset here. So this is a decentralized exchange. So we'll go to trade and swap. From here, I know I have some BNB. So we're going to use BNB and we're going to swap it into Tether. Click on this one down here, switch to USDT. That's the asset that I want. So we're swapping BNB into USDT. What you can also do here is search a token via its token address. So right here is a list of tokens that PancakeSwap has, and these are tokens that it thinks are legitimate. You can see that USDT is listed on CoinGecko here, right? I've got USDT that it's, I've already selected this one, so it knows that I've got it. But what happens if you're searching for some random meme coin or something? What you can do is go over to CoinGecko, see Tether here, we'll click this. Up in the right, it's going to give you the contract address of this token. So click these and you should see all of the different addresses. Now, each blockchain is different, and so it has a different contract address on each chain. We're going to search for BNB chain, wherever that may be, right? Just wherever it is. And then you can go and copy that. You've now copied the contract address of this token. You can go back to the exchange, you can press paste, and it searches for the contract address. So you know that you're getting the real thing. CoinGecko is reliable, so you can search for it. This isn't found because I've copied the Ethereum address, and that's different to the address on the BNB Smart Chain. That's just a way to get some more valid token results if you can't find them through the search page. From here, I've got BNB, so I'm going to swap 25%, and I'm going to swap it into US dollar Tether. So that's here. It tells me what the exchange is. I'm going to press swap. So if you want to know exactly how to use PancakeSwap with the settings and everything, I'll leave that for that video. But we're going to swap, confirm. Now, if you haven't ever used a blockchain before, what these applications do is they have to ask for your permission to manipulate your account. What it's going to do is say, if you've never used USDT as a token before, it's going to say that you have to approve the application to manipulate this token in your account. And you're going to have to accept and sign a transaction that approves this token. So you have to go through that with that transaction. For me, I think I have it approved already. So I'm just going to update the price and press confirm swap. It's going to take me through to my wallet. It says these are the details of the swap, and it's going to cost me 18 cents in gas. I'm going to press confirm and transaction submitted. You can add the token to your wallet on MetaMask or the others. If you want to press that, you can see that the transaction has gone through and I've got a transaction receipt here. I can click this and it goes through to the Blockchain Explorer, which will give me every minute detail of the trade, the time, the timestamp, how much was done and everything, and the token addresses. But that's it. That's traded. So we've used a decentralized exchange to swap one asset for another. Now that I've got some Tether in my account, I can go and lend that out in DeFi as well. So on BNB Smart Chain, Venus is the lending protocol. Not saying that BNB is good or bad or anything. It's been around for a long time. It's fairly cheap, and so I just chose it for this example. But there are many other chains that are great, that work really well as well. You can find them all. So this is a lending protocol, so I'm going to connect my wallet. MetaMask should be connected. And then from here, it's going to identify the assets in my wallet. And so it should tell me that I have some Tether, because we've just swapped into some Tether. So what we can do, you go to the dashboard. You should be able to see what you've got. So you can see the wallet here. It shows me that I've got this amount of Tether in my wallet, right? 396 that we've just swapped. And so you've got for a lending protocol, you've got different ways to use it around the protocol. So I've got this Tether in my account. So what I'm going to do is go to the core pools. And then what we're going to do is go to the asset that we have, which is USDT. So I'm going to click this. And you can see that this is a lending protocol. So if you supply, you're going to be getting, at the moment, 7.44% yield. If you borrow, you have to pay 10% to borrow. And the spread in between is probably what Venus makes themselves, right? Plus probably some extra for potential liquidations and things like that that may happen. This is a floating rate of interest, as you can see. So it's not fixed income, it's floating rate, which means that the asset yield can be anything dependent on supply and demand. But at the moment, it's 7.44%. So what we'd want to do here is go and supply. So it says supply, we've got USDT. So we'll click max. So we're putting this in. And you can see we're supplying at 7.44% APY. You're also getting an incentive from this protocol with their token called XVS. They're paying you a tiny amount as an incentive and extra. A lot of protocols do this to get you to use them, but obviously this is irrelevant because it's tiny. Total APY is 7.48, and we can approve USDT. So I've not approved for this app. This app does not have permission to use USDT from my wallet. So now I'm going to have to give them permission. So we'll approve first, approve USDT. Going to go through, we're going to have to sign this transaction, and it says, what is the spending cap? Custom spending cap is, just choose max. What this means is I'm approving this protocol to manipulate $3.96 per transaction. That's the amount that I need. What I'm going to do is just change this to $100. And it says, be careful, do not give them access to all of your money, but $100 is fine, right? So I'm going to press next. I'm going to have to pay 4 cents for this transaction. 4 cents in dollars in cost, but that's an amount of BNB, but it just gives us a dollar amount. That's gone through. So now I can supply this token and actually use this smart contract. So I go through. This is going to cost me 24 cents. Press. And transaction completed. So what I'm doing now, well, actually we're waiting for it up here, but what I'm doing is supplying dollars on a lending market, and I'm receiving 7.46% yield on the dollars that I'm lending out. Most protocols like this, where you have a balance and something that's happening in the protocol, give you a dashboard. For exchanges, they don't do that because you come in, exchange, out, and it's done. But obviously for a lending protocol, we have assets that are tied up here, right? And so you can see the summary of my account. My net APY is set 7.5%. My daily earnings are going to be tiny because I'm only supplying $4. Down here, you can see the summary of my account and all of my supplied assets. So I'm supplying this asset right here. So I can click on this. I can withdraw it, press max. This is the amount that I can withdraw, pay another transaction. So come through, you have to pay this, press confirm. That will withdraw that from the lending pool. and that will bring the Tether back into your wallet, so it's not tied up anymore. I hope this course was helpful. If you want the professional version, that is linked at the top of the description, and I update it for free for existing users with my latest research and everything going on in crypto. All of the other resources will be linked down there as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.